Hello everyone, I'm sure you're doing great. I am CA and today I've come up with a quick revision of your PM syllabus. Not in days but in just few hours so that the concepts, clarity is 100% and everything is very crisp for you to use it in your exams. First, I'm taking the topic absorption costing and ABC, one of the most important topics which is covered in the as an important testing area for all the three sections A, B and C. Let's go into this topic. So now we know that absorption costing and ABC are the two overhead allocation methods to allocate the overhead cost to the product cost, although the two are different in their methodologies. Absorption costing typically helps to calculate a single rate that will be applied on the basis of labor hours or machine hours or any other activity level that the entity may deem fit, and we calculate that single rate, and based on the consumption of labor hour or machine hour by each of the products, the overhead cost is allocated to the product cost. Then under ABC costing, the overheads are subdivided into the various overheads, which may be like 5-6 different kinds of overheads. For each overhead, we calculate a rate, and then based on the consumption of that activity level to the different products, that overhead is allocated to the different product cost. So in ABC, instead of a single rate, we have multiple rates, and in absorption costing, we have a single rate only. Now let's go further into it. So quickly, absorption costing follows the full cost model, and that says that the full cost should be absorbed in the product cost. In fact, overhead the ABC costing also follows the full cost model only. Now here we calculate the overhead absorption rate, and while calculating the overhead absorption rate, we calculate it as budgeted production overheads divided by total production hours. Now these budgeted hours can be machine hours, can be labor hours, or can be any other activity levels, which sometimes we even calculate with direct material cost as well. So depending upon the entity's policy, we calculate the overhead absorption rate. This simply depicts the overheads, that how they are absorbed into the product cost. And based on this rate, then we calculate for each of the product what is the hours consumed. We multiply this rate and get the total overhead cost for each of the product, which we then add to the other cost and get the total cost for the products. Divide by the number of units and we get cost per unit for each of the product. Now when we move to ABC costing says this method is not acceptable. So it follows these four processes. First is allocation of the overhead cost, reapportionment of the overhead costs to different production departments or different departments, which can be service departments as well as production department, and we only allocate production department overheads to the product cost. Hence, we need to reapportion the service department overheads to the production departments, so that cumulative all costs come in production departments, from where we allocate the cost to the different products, and then we absorb these costs to the product cost. So this is the system that we follow. Now, a background of ABC, in basically the need evolved because in 1950s, around that time, when overheads used to be very less amount of the total cost and labor cost used to be very heavy amount of the total cost, so there the need for absorption costing was more. But now with growing demands and more cost of overheads in relation to the direct cost, there is a need for a better and a more detailed method of absorbing the overheads to the product cost, for which we have ABC costing in place. Activity-based costing says that since your direct cost is less than the total overhead cost, and so it really does not matter what is the percentage of units which is generated or percentage of hours which is used by each of the products. Instead, let's break down the overheads and then calculate the overhead cost in respect of the usage by the different products and add them up to get the total overhead cost for the product. That is, simply speaking, if I summarize the steps in ABC, step 1 says make detail of overheads. That is the subdivisions of the overheads into multiple heads or multiple activities, like the production running cost, the production cost, the machine setup cost, ordering cost, so on. Identify the different cost drivers which drive these costs So for production cost, the number of production runs will be the cost drivers. For machine setup cost, number of setups can be the cost driver. And likewise, for the ordering cost, number of orders can be the cost driver. Then calculate for each of the subcategory of overheads, cost per cost driver. Finally, based on the cost drivers used by each of the different products, we apportion these overhead costs for each of these products based on the actual cost driver used. Calculate it and apportion the overhead cost to the product cost, add it with the total cost, divide by the number of units to get the total cost per unit of each of the products. I'm sure with this crisp summary, your ABC costing and absorption costing are absolutely crystal clear. Now let's progress ahead and let's take the next topic, which is life cycle costing and target costing. These are those topics which you will find in every exam term in your section A typically. Life cycle costing. Life cycle costing simply says that all the cost that arises right from the product takes birth until the product dies. In that life cycle, all the cost that comes in, you accumulate and you take it as a life cycle cost. So which is the stage at which the product actually comes into the world? That is a product is born. Which is that stage in which the product is born? It is after the research stage, because once your research is done, then we zero down on the product that we want to develop. Development means born. So it's typically the development stage, design stage where the product is born. And a product dies into the decline stage. That is when now the product needs to be phased out of the market. So all the decommissioning cost, all the costs like this, they will fall in that category. So remember always, from the time that the product is born till the time that the product dies, all the cost you will accumulate and you will cumulatively call it as life cycle cost. So which all stages are covered? Let's have a quick summary. So always remember, the life cycle cost accumulation will only start after the research stage. Next, all the development related expenses like planning, designing, prototype developments, etc. will be there in this development phase, and this is the stage 1 for the product to be included for the all the cost to be included for the life cycle costing. Major cost is always incurred in this design phase. Favorite MCQ questions in section A and section B, where students get troubled when they see development phase and research phase. So remember, life cycle costing starts post research phase, because of course we zero down on the product after the research has been done. So major cost is always incurred in this design, planning, development stage only. Next is the introduction to the market and expenses like marketing, advertisement, salary expenses, and they are mainly fixed costs that get incurred here. In fact, in the development phase, we have fixed cost, we have the non-current cost also that gets incurred, because we're developing the capex, which also gets more in the introduction phase. So introduction phase is all about incurring more into fixed cost, heavily into marketing and advertisement. Post this, finally the product, no, during the next phase, the product remains in the market. That is the growth and maturity phase. Maturity phase is the phase where the product profitability sales is at peak, because it is the most selling time of that product's life cycle is the maturity phase. So generally here the cost that you will have in the growth and maturity phase are likely to be variable cost only. Last is the product's phasing out stage, which is the decline stage. So finally the product phases out of the market, and the cost like disposal cost, decommissioning cost, they are incurred here. That's all you need to know in the product's life cycle. So right from the development stage and design phase to the declining phase or the phasing out phase, everything will be accumulated, whether it's a capital expenditure or revenue expenditure. Everything will be added together, and that will be your life cycle cost. To get the cost per unit, you will divide it by the number of units that we expect the product to be producing. I mean, the manufacturing of the product for the number of units will take place in that life cycle. All costs from development stage to phase out stage or decline stage are to be included. Done with your life cycle costing. Let's move forward and let's take target costing. Target costing is basically, we will follow here reverse order. Normally what we do is we fix the cost, we add margin and we get the selling price at which we are going to sell in the market. But market is competitive, so we go reverse. We have the market price less the target profits and then we get the target cost. So aim is always for the business to minimize the cost gap, which is the gap between the target cost and the actual cost. So then what all ways can be adopted to minimize it? Again, frequently asked topic for your exams. For reducing the cost gap, strategies that can be adopted are like value engineering and value analysis. What is value analysis? Value analysis is where the focus is on enhancing the use value of the product. Use value means that is maximizing the usefulness of the product, maximizing the ways in which the product can be used. And also aim is to enhance their prestige value. Prestige value is basically the value relating to the standards of the product, quality levels of the product, customer service enhancements of the product. Prestige value is simply that you attach status symbol to it. So always remember, value analysis means that you analyze the product with the reason to enhance its prestige value as well as its use value. So let me quickly take up the 4 values that are tested in your exam and that you need to know from target costing. Number 1, use value. Use value means simply the product's ability to perform multiple functions. One product can be used for multiple uses and that is its use value. Exchange value is the value at which the product can be exchanged. That is simply its market value, its market worth. Cost value, it is simply the cost to manufacture the product, to make it manufactured, to make it ready for sale. And the prestige value, or we call it as esteem value, is simply the status value also we call it, the added appeal of the product that attracts customers' attentions. Okay, so that attracts customers' attentions is your esteem value. So now obviously the value to maximize is esteem value and use value. When we enhance these values, the overall market value of the product will go up. Now let's go to value engineering. Value engineering basically says that you make changes to the product to bring economies of scale, that is make it cheaper at the highest quality. So at the time that we like to reduce on the cost so that we reduce the cost gap, but at the same time we focus on that we don't compromise with the quality. So at one point we are lowering the cost and on the other side we are trying to maintain the quality or enhance it but not lower it. So this will take place in the planning and design phase, as this is the phase where maximum expenditure takes place. So we can have the actions like removing the unnecessary parts or the unnecessary accessories. Example, nano was the best example for it, where economies of scale were brought into place and without affecting the quality of the product. That's all for life cycle costing and target costing. I hope this crisp summary saves your time. Moving to the next topic is sustainability and environmental accounting. Sustainability is the talk of today, and for ACC it is a very, very important topic. What kind of questions can be asked for sustainability? Always remember, keeping in mind that we should go hand in hand with the environment, with the society, doing things for the society, governance as a whole, doing everything right and with no penalties, with everything falling in the right place is what sustainability talking about. So simply it says that for environment point of view, that save it by growing more trees. Businesses should contribute to the country, like for example, enhancing the economy performance of the country by eradicating poverty and ensuring that there is reduction in unemployment, by doing their duties towards the government, that is by paying taxes on time, towards the staff by giving them good working conditions, equality of pay and gender equality, Then towards the public by giving them different job opportunities, opening more hospitals, opening more schools, and eradicating poverty, working towards that. So sustainability is a comprehensive term for everything. In PM, we are not covering it in much detail here, but of course, it means about businesses should not just look into profitability; they should go beyond it. Moving to environmental accounting, one of the frequently tested topic and regularly asked topic for both section A and B. This is a topic that you will obviously look for in your exam. So as per Henson and Mendoza, so there are two types of environmental cost categories. One that is given by Henson and Mendoza, and the second one is given by the US Environmental Protection Agencies. Both are very important. Henson and Mendoza typically talked about that the environmental costs are divided into four main categories. Number one, prevention cost. Prevention cost, as we say, for example, having clear-cut organizational policies on environmental accounting and following of rules and regulations. So it is a cost that is beforehand cost. Before the damage is done, before anything is done, we incur this cost to ensure that damages are not there, penalties are not there. Detection cost is a cost that is the system in place to detect whether any environmental rules and regulations are breached or not. For example, having a system to check carbon emissions from the factory. Okay, let's say we had a system in place where the carbon emissions could not go out of the factory, but now if we feel they might go, then we have a system in place to detect that. Third, internal failure cost. It means that now there has been some damages towards the environment. There has been some actions that have been taken, or the processes of the organizations have led to some of the wastages being produced. So how to control that wastage so that it does not get released into the environment is your internal failure cost. Like recycling of scrap. It means the environmental damage is done but is still contained in the factory and is still not released into the environment. That is your internal failure cost. Next is external failure cost. That simply says every damage has been done. The cost has gone into the environment and it is now done the damage, that now we will just have to bear the penalties for the damages that we have done. For example, paying fees and penalties for the emissions that are beyond the limits. So remember these four things: prevention, detection, internal failure and external failure cost. Next is the environmental cost categories, which is suggested by the US Environment Protection Agency. So as per this, the environmental costs are again divided into four categories. First is the conventional cost. Conventional cost is basically, these are those costs which are usually identified and accounted for in the company's normal or traditional accounting system only. So these costs are already accounted for somewhere in your normal accounting system. We don't have to really account for them separately. For example, cost of disposing waste, or energy cost like electricity, fuel cost of running pollution control equipments. Okay, so these costs are already relating to environment, to the energy, and that is already there in the cost accounting processes, already, which is there. Potentially hidden costs. These costs are also accounted for in the P&L or in the expenses, income of the entity, generally expenses, but they are hidden in the overall cost. For example, it is there as a part of overhead cost, general cost, selling cost, but it is not specifically shown as environmental related cost. So these are potentially hidden costs. For example, pollution related cost, water scarcity cost. So basically these costs are a part of other costs or overheads which are captured by accounting systems, so they remain hidden or they lose their individuality. Now we have to take out these costs and show them individually as a separate cost, which is a treatment for potentially hidden cost. Third is the image and relationship cost, that is completely related with these costs are generally incurred by the entity to build a good image of the entity so that it is well receptive by the public. For example, incurring expenses on producing the environmental reports, maintaining the public powers, doing these CSR activities. Fourth is the contingent cost. Now, those costs that we think will take place in the future, but of course, that are depending upon the happening or non-happening of lot of events. So, those costs are known as contingent cost, and these costs are going to be incurred at the future date only, like decommissioning cost, like landfill cost, like cleanup cost. So these costs are categorized as environmental cost. Simply speaking, all these costs should be specifically shown on the face of P&L so that controlling actions can be taken to reduce them. That's all for sustainability and environmental cost. Let's move on to the next topic. Yes, guys, so let's continue and let's move on to throughput topic. Throughput, yes, we all know it is a topic that you find in every exam paper. So let's go into this topic. Like we have contribution, that says to maximize contribution would mean that sales less variable cost. Throughput discusses about maximizing the throughput, and throughput is simply selling price less all cost. Okay, so here, throughput basically discusses about selling price less only the material cost, because under throughput accounting, the variable cost is only material cost, labor cost as well as operation and the other expenses like variable overheads, like fixed overheads, they all are fixed cost. They all are the operating cost that we call as the fixed cost or the factory cost here. So normally profit is sales less all cost, contribution is sales less variable cost, but throughput is only sales less material cost only. Labor cost is always a fixed cost when it comes to throughput. It assumes labor cost as a fixed cost in the short run, and throughput is always short run focused. Typical MCQ question in the exam. It is never long run oriented, it is a short run oriented cost. So the factory cost or the operating cost includes direct labor cost also. Throughput focuses on bottleneck. With throughput, always remember you will have the term bottleneck. So if a question has a bottleneck term, that gives you a hint, it's a throughput question. Bottleneck simply means that it is a constraint or a blockage in the full capacity utilization of the business. For example, I want to drive car, but I don't have a license. So license becomes my bottleneck. Okay, so bottleneck is what is hindering the company, what is stopping the company to use its full capacity. Now, here I've given an example for bottleneck. So, for example, the aim is to print the book. There are 4 activities involved in it. Write pages, we can just write 70 pages. An editor can edit 100 pages. Reviewer can review 90 pages and publisher can publish 110 pages in a week. But overall, we would not be able to go beyond 70 because a writer is only writing 70 pages. So even if editor, reviewer, publisher have more capacity, still it doesn't make sense because a writer cannot write beyond 70. So in any case, and none of these activities can go beyond 70. So here writers is my bottleneck. Now, the focus of throughput is always based on the theory of constraints that simply says that your steps in the throughput process should be identify the bottleneck, try to maximize the throughput considering that bottleneck. So we calculate throughput per bottleneck hours and we do the ranking of the product and try to manufacture the product to achieve the maximum throughput by making the production of the product rank 1, then rank 2 and then rank 3 and so on. The aim of the business is always to maximize throughput. And once we know a bottleneck is there, every effort of the entity should be to elevate the bottleneck and not the other non-bottlenecks. The bottleneck should be elevated. Once it gets elevated, then there can be other bottleneck also that will get created. It's a vicious circle. So always you'll have one bottleneck always there. There can never be a time when bottleneck process will stop. So if one bottleneck gets removed, another gets added. Remember it. Now, few ratios to remember in this chapter. Number 1, return per hour. That is throughput per unit divided by the scarce resource or the bottleneck per unit per hour. Okay, what is the bottleneck unit required per hour that we will take? Then we need to calculate cost per hour, which is operating cost or the factory cost, which is simply equal to the all the cost except for material cost. Add them together, divided by the total number of bottleneck hours, and then we get the cost per hour. One point important, please don't forget, return per hour is always calculated on per unit basis. Throughput per unit divided by hours per unit. And when we say cost per hour, it is always based on total calculations. Total cost by total bottleneck hours. Okay. Then TPAR, you will calculate throughput accounting ratio, which is return per hour by cost per hour. Let's take a quick example. So let's say that product 1 requires 4 machine hours and machine time is the bottleneck. Total available hours are 650 hours. Selling price is 120 per unit. Material cost is 35 per unit. Other factory costs are 13,000. Let's first calculate return per hour. So throughput will be 120 less 35, which will be 85. And 85 divided by the hours per unit, which is 4. So we will do 85 by 4 and I get 21.25 as a return per hour. Cost per hour will be 13,000 divided by 650. The total hours by total cost by total hours. Total factory cost by total bottleneck hours. So we get 20. So throughput per hour will be 21.25 by 20, which is 1.0625. Now, is this a good ratio? Yes. If it is more than 1, it indicates that the return is more than the cost. So, of course, it's a beneficial ratio. Now, how do we rank the products? So, remember, whether we rank the products as per throughput per hour or TPAR, the steps that I'm going to give you now, the summary steps, are going to remain same. So make sure that you have a hold of these summary steps. Step 1, calculate throughput per unit. Step 2, calculate bottleneck hours per unit of the product. Step 3, calculate throughput per bottleneck hour. Calculate throughput per bottleneck hour. Rank the products as per the throughput per bottleneck hour, with the rank 1 going to the product with maximum throughput per bottleneck hour. And then you give rank 2, rank 3 and so on. Optimum production plan will be the one that will maximize the throughput overall for the entity so that it is able to cover sufficiently the operating cost. Hence, the product with maximum throughput will be manufactured to the fullest, then the next rank, then the next rank. And of course, the last products that have got the lowest throughput will be only able to get few hours only, and based on which few units only will be produced. So the aim is to maximize throughput and maximize the profitability of the organization. And the aim is so that the maximum demand is met and that gives the maximum advantage to the entity. That's all for throughput. Let's move on to the next topic. The next topic that I'm taking up is CVP analysis, that is cost volume profit analysis. Yes, in this topic, we typically talk about break-even point. What is break-even point? Remember it always for all the formulas. This is very important to understand. Break-even point is the point or is the level of units, level of revenue where your profit is not there, no loss, no profit. That simply means that your cost is equal to your sales. So there is no profit, no loss. Okay. Now here we focus on calculating both break-even point in units as well as in revenue. Revenue would mean that you calculate the break-even point in dollars. okay, in the value figure. So now for a single product environment, what is the break-even point in units? Simply it is the point where you have no profit, no loss, which is where your fixed cost is equal to your contribution. Simply the point. So what is break-even point in units? It simply means that what are the sale units at which point your total fixed cost will be equal to total contribution. So break-even point in units is fixed cost by contribution per unit. Because when I multiply contribution per unit with this break-even point units, then total of the contribution becomes equal to the total of fixed cost. Now break-even point on revenue, very easy. Once you get the break-even point in units, you multiply the selling price per unit and you get break-even point in revenue. Alternatively, we can calculate it as fixed cost by contribution by sales ratio, that is CS ratio. So single product is that, get the single product CS ratio and get it divided by fixed cost and you will get break-even point in revenue. And if you want to calculate from break-even point in revenue, break-even point in units, simply divide this revenue by selling price per unit. Okay, so any of the ways you can calculate these two values. Now CS ratio, we know it is contribution upon contribution per unit by selling price per unit. We never calculate total contribution by total selling price, sales value. We always do contribution per unit by selling price per unit. Because as it is, we are calculating your break-even point. So we are calculating the units levels only. Now in a multi-product environment, to find the break-even point level for the organization sales, the need to calculate is the weighted average. So there is a need to calculate weighted average contribution per unit as well as weighted average CS ratio also per unit. These two things we require, weighted average contribution per unit and weighted average CS ratio per unit. Okay, in fact, here when we have the multi-product environment, because we apply weights over there, weights are the quantities or the ratio in which the goods are going to be sold for each of the products. Okay, so that is, since we have weights, therefore we can get the totality also. So we can have the CS ratio per unit or in totality it will give the same answer. So any of the two methods can be used to simplify in case of multi-product environment. So what are the methods to use when we have the multi-product environment and we want to calculate the break-even point in units or in revenue? So two methods are there. First method is that I find very easy and which I generally recommend for everybody to follow is calculate the weighted average CS ratio. Okay, then calculate the break-even point in units by having the fixed cost divided by weighted average CS ratio. Allocate to the products in the ratio of their weighted average selling price. Remember, you will always do allocation. You will always do allocation in the ratio of weighted average selling price only, not the simple selling price. Because there are multi-products, so assign weights and get the weighted average selling price. Once you do that, then you can get the break-even point in units by dividing the product's revenue by the respective selling price. Other way around is calculate the contribution per unit for different products and get the weighted average contribution per unit. So now instead of CS ratio, get the weighted average contribution per unit and calculate the break-even point in units by dividing fixed cost with weighted average contribution per unit. Allocate units to both the products or to 3, 4, whatever the products are. Then multiply selling price to each of the products to get break-even point in revenue. So either you start with revenue approach and get the units, or you start with units approach and get the revenue. Clear? Now, few pointers to note if you are creating the multi-product PV chart. What are the pointers to consider? Because they are frequently tested in exam. The charts are asked. You are never required to create charts, my friends. But charts are asked, charts are shown in the question and you are required to select the correct answer. For this understanding is very essential. Like the PV chart drawn for multi-products in accordance with the product with maximum contribution to be made first will touch x-axis at the early break-even point. It simply means when you're drawing the PV chart and you create the PV line, the profit line based on the ranking of the products, that is a product with the maximum contribution is first produce, then the next, then the next. So obviously here we are aiming at maximum contribution, and so the units are sold first for the products with maximum contribution. So they will give rise to early break-even point. Always remember that they will give rise to early break-even point. Next, but then what we do to get the actual and the correct break-even point is you will create multi-product PV chart by not ranking the products as per the contribution per unit, but or the total contribution, but by ranking the products as per the CS ratio. So then when you rank the products in a multi-product PV chart as per the CS ratio, it will exactly touch the x-axis at the correct break-even point. On x-axis, you may have the revenue figure which is there. So on x-axis, it will touch the break-even point at the correct revenue figure. So you will always get your answer with perfect break-even point in revenue if you rank the products as per the CS ratio, weighted average CS ratio. Okay, and in fact, they're individual CS ratios. Okay, I hope I'm very clear till this point. Let's go to the next topic. Yes, so let's continue to the next topic, which is limiting factor analysis. All of you know that this is a constraint analysis and which is a frequently testing area, especially for section B. Okay, so let's discuss here. Here we also discuss about constraints. Now in throughput, we discussed about bottlenecks. In limiting factor, we discussed about constraints. Constraints are just like bottleneck. They are the ones that are limiting or delaying, or you can say they are kind of a blockage, a stoppage in the production process, which is reducing the overall production capacity as well as the selling capacity of the entity, because of course production and selling are linked to each other. Now what can be the different constraints? Now constraints can be labor time, can be the department time, can be the material availability, shortage of material or excess of material, can be the market demand, which is very common constraint that you will generally find in all constraint questions, that there is the limitation of maximum demand. Then of course money or funds availability can also be a constraint. So now in this limiting factor analysis, we generally talk about two types of constraints. One is a single constraint and another one is a multiple constraint. But in your syllabus, we just have two constraints only in the multiple category as well. Maximum two constraints. Constraints, when I say, that means no, not maximum two constraints, but in your syllabus, we will have two variables. Constraints can be multiple. Constraints can be 3, constraints can be 4, constraints can be any numbers. But variables will only be limited to 2. That means you will not be solving questions beyond 2 variables. Clear? Now let's go forward. So now in throughput questions for bottleneck, our aim was to maximize throughput per hour. And here our aim is to maximize contribution. So we will only make the goods in the ranking, in the order in which the contribution is maximized. So calculate contribution per hour. R is the limiting factor here. Now whatever is the constraint, you will calculate the hours, or sorry, you will calculate the contribution per that limiting factor, per that scarce resource. Okay, so now when you do it, you will do the ranking. Rank 1 will be the product that will give maximum contribution, then rank 2 and then rank 3. Exactly in this same way, we will do the optimum production plan so that the contribution is maximized. Always remember, in these constraint questions, we just have one agenda: to maximize the contribution. So for example, here I just taken a quick example for that understanding. There are 3 products. There are contribution per unit given for the product. Labor hours per unit is given to you, because in this question, labor hours are a constraint. Okay, so they are giving to you. Now you will calculate labor contribution per labor hour. Now if you can see here, for product A, contribution per labor hour is 5. Product B, it is 6.25, and product C is 10. So C is giving you the maximum contribution, hence we will rank it 1, then B 2, and then A 3. Now in this ranking only we will be selling the products, or we will be making the production plan, which clearly means that we will make product C first, that is for 6,000 units, that is its maximum demand. And in this example, while I took it, here there was a minimum demand of product A to be met. That means whatever is the scenario, product A minimum demand is met. So here therefore I took the minimum demand first, which means always in your exam, in your questions, make sure that you take the minimum demand first, that is to be met whatever is the situation, and then we take the products as per their ranking to maximize the contribution. So here the price that I'm getting is 38,750 my contribution. That means this is the maximum that the entity can achieve. Okay, now here I will first take few concepts, then I'll come back to a concept called shadow pricing. Okay, so first let me take the summary and then I'll take up shadow pricing. Limiting factor analysis. So if I summarize, when in a single constraint, what are the steps that you should be following? Is step 1, calculate the contribution per unit for the products, the multiple products. Get the scarce resource per hour for each product. Okay, what is the scarce resource per unit for each product? No, scarce resource. Let me just correct it. Actually, should we get scarce resource units for each product? It can be hours, it can be kgs, whatever it is. Then you will calculate contribution per hour or the unit of scarce resource. What if the scarce resource is material? Okay, then your whatever the scarce resource is material, so then we will calculate contribution per kg. So that depends upon what is the scarce resource. Then you will rank the products as per the contribution per hour or again per unit of the scarce resource. Okay, like here the product which has got the maximum contribution per scarce resource will be ranked 1, then rank 2, and accordingly we will go down. And then we will create the optimum production plan. Like we saw in the example above, optimum production plan is the plan where the contribution is maximized. Now I come to a question where you have multiple constraints, but then you just have 2 variables. Constraints can be multiple. Constraints can be like assembly time is limited, labor welding time is limited, machining time is limited, demand is limited, demand is not maximum. So like this we can draw down the constraints and then we will be solving the question. So let's look at the multiple steps for the 2 products which have several limiting constraints. Like, so what are the steps that you will be following? You will do step 1, that is contribution. Objective function is always the first step. You will always create the objective function first. This is the purpose for which you are doing all the calculations. So that will be contribution per unit multiplied by the number of units of product A. Now we don't know, because in the limiting factor constants, what we have to find out is what is the optimum production plan. So we don't know that, hence we will take it as X variable. For example, let's see, we will add up contribution per unit of the other product. Let's keep it as Y. So let's say if the contribution is 10 for product A and 20 for product B, then I can create an equation as 10x plus 20y. Okay. Second is find out the variables. Here you will always have 2 variables. In your PM exams, you will not work with more than 2 variables. So x and y are the variables typically that we can use. Now we will create the constant equations. Note, for constants we will have always less than equations, always less than equal to equations, because constants always means that there is something which is always less. Okay, so we will create these constant equations which are less than equal to equations. Now once you create the equations, the next step is you have to get the coordinates of x and y. So in this equation, you will keep one variable as 0 and then get the other variable. For example, you keep y as 0, you will derive the value of x. You keep x as 0, you derive the value of y. So likewise, you will keep x as 0, derive the value of y, keep y as 0, derive the value of x for all constraints. so that you get coordinates for all constraints. Then on the graph, the coordinates get plotted and the different constant equations get plotted. Once you plot these equations, and you know these are less than equal to equations. So for example, if I do a plotting here, so let's say I have this graph, one equation is like this, one is like this, one is maybe like this. So let's say we have these equations, so then my feasible region will be always the region which is the common region when it comes to less than. So here my feasible region will be this, this, this and this. This will be my feasible region. That means your answer for optimum contribution or optimum production plan will be falling in these area only. Now typically then how do you find the constraint, the point at which you will have your constraint, the binding constant that we say, that means the solution of where at that point you will get your optimum production plan. So which are the points to note here? This is point 1, point 2, point 3, point 4. This you will always ignore because it is 0, 0. So it doesn't make sense. These two are also very less likely. So always remember, as a trick, you'll always have points in between. Now how to know the points? So quickly for that we plot the contribution line. Again you will use there some imaginary numbers and try to get the coordinates to plot the contribution line, that we also call as ISO contribution line. Why do we call them ISO? Because they are parallel lines, they don't meet. So let's say if my ISO contribution line is this, you keep on drawing this line till the time you don't meet the feasible region. So the point where you have your feasible region touching, that becomes your point at which you will get your maximum contribution, the optimum solution point, which here is coming as this point. So then how would I know the number of units for this? Now at this point, you will solve the equations parallelly and simultaneously, that we say, and you will use the algebraic method for the same. How to do it, I'll tell you. So let's check it here, how to solve the equation. Now for example, here I've taken an example here just to make you understand how to solve the equations. Now let's say here I have two equations like 0.75p plus 1h is equal to 300 and 1.5p plus 1h is equal to 422. Now solving the equation simultaneously would mean that you take a common number and multiply the top row with that common number and this down equation with the common number of this equation. Meaning to say that at least one of the variable on cancellation should become 0. For example, here I have 1h and 1h being common. Why? My original equation was this: 1.5p plus 2h is equal to 2600 and 0.75p plus 0.5h is equal to 211. In order to make one variable 0, let's say I've chosen this variable, then I will multiply the numerator with 0.5, which is this, and I'll multiply all the numbers here in the denominator with 2. So when you multiply 0.5 with 1.5 with 2 and with 600, I get it as 0.75p plus 1h is equal to 300. Likewise, I will multiply 2 with the entire denominator variables. So I will get here 2 into 0.75, 1.5p plus 1h plus 4 is equal to 422. When you solve it, I get the value of p. Now put this in any of the equations and get the value of h. And that is your optimum production plan at which you'll have the maximum contribution. So now continuing to what we said, once you find the feasible region, now you have to follow the ISO contribution lines method by plotting x and y coordinates by randomly taking the value of the contribution. Like we just discussed, take any random values for contribution and just get the values of x and y. Okay, at least 2 to 3 values you should have so that you know the slope of the line. Slope is very essential because slope will determine where is this line going to touch the feasible region. So the line which is going to touch the coordinates at the feasible region is that the coordinate then will be the coordinate where you'll have the maximum contribution. Okay, like I told you, because the slope of the line, the ISO contribution line will determine the coordinates where the ISO line will touch the feasible region. And that coordinate is the point where your contribution is maximized. Now we can find out the value of x and y by using the graph method. Graph method is just try to approximate the value of on the graph for x and y, which is generally not recommended. But then when you're doing a section B or A question where you just have to select the correct option, then you may just get an approximate idea from there. Right? So that can be the answer then. But when you're writing a section C question, you need to elaborate these steps and write the answer exactly in the same steps like I have given here. Okay, so we follow simultaneous equation solving method. Once you get the values of x and y from the simultaneous equation solving method, then put these values of x and y in the contribution objective function and get the maximum value of contribution over there. Moving forward, now constraints can be two constraints, the terms that you will be looking, you'll be finding in the exam, which is binding constraint and non-binding constraint. What is the binding constraint? The intersection point. Okay, those lines at the intersection of which we got the optimum solution is known as binding constraint. Why? Because the x and y value that we derive, you can see we derived with the equal to equation. So that means for these two equations, your both sides will be equal. You will never have more hours, you will never have less hours. Both will be equal. Okay, so therefore that means that your resources are going to be 100% utilized. Other than these equations, other than these constraints, like in this example, if I got the maximum contribution at this point, this was at the intersection of this line and this line. So that means this line will be a non-binding constraint. That means it will never be used up to the fullest and it will always have some extra hours with it, some spare capacity with it, some extra hours with it. Okay. So when we have some extra hours, there slack arises. Slack is always the extra resources available which are not fully utilized and which is always with the case of non-binding constraints. When we go to binding constraint, now you don't have even 1 hour extra. So to get 1 hour extra, that is known as shadow price. The price which the entity is ready to pay to get 1 hour extra. So what is that price? That price will be extra contribution. So always remember, shadow price is always what is the extra, what is the contribution earned? What is contribution earned for getting that 1 extra hour of the constraint? Okay, what is the contribution earned? So that is known as the shadow price. Right? I hope I'm clear. Okay, just one example for slack. Maximum demand for H is 250 units, but actually as per this, the production of H is considering constraint is only 180 units. So production we have done only for 180 units, capacity is 250 units, so we have a slack of 70 units. That means H has an extra capacity, extra hours of 70 units. I hope I'm absolutely clear with this summary. So just have a quick revision again for these multiple constraints because they are quickly asked, always asked in the exam. Step 1, contribution objective function to be created. Step 2, find out the variables. Step 3, create the constraint equations which are less than equal to. Step 4, find the feasible region. Step 5, follow the ISO contribution line to know the coordinate at which your contribution is maximized, and that is the optimum production, to be done. Step 6, find out the values of x and y, either by using the graph method if you just have to get the approximate values for your MCQs, and for section E and section C, and otherwise also we can follow the simultaneous equation solving method as well. Finally, step 7, when you put these values in the objective function and get the maximized contribution. Now let's go on to the next topic. The next topic that we are taking up is a very, very essential topic again. Now you'll say, ma'am, you're saying for every topic it's very essential. These are actually tested frequently. This topic, especially like risk and uncertainty in section C as well, in section B as well. So these are favorite topics for section B. Now, risk and uncertainty, basically for that, let's just have a background understanding of these terms. Risk and uncertainty are both related to each other. So they are both relative terms. Risk definitely relates to the risk for a business is what if the customer demands go down? And uncertainty is what can be the different possible outcomes that an entity can have for its sales demands. Depending upon the different conditions, like a sales demand is weak, strong, or moderate, you can have different outcomes. Now we assign probabilities to it, we multiply it and get the expected sales outcome that we use considering the uncertainty portions. So therefore we apply the expected value method for the same. Now risk is generally then that if the sales can go down, then we offer good discounts to the customers, we offer them freebies, we offer them loyalty discounts, so that, and we also explore new investment opportunities, new markets to expand our customer base, so that we can mitigate the risk and reduce the risk. So now, in this chapter, most essential is to understand what is the attitude towards the risk of the persons. Is the attitude towards the risk of a risk taker, or a risk neutral person, or a risk averse person? Risk taker is somebody who believes that higher returns mean higher risk. So he's always going to look for maximizing his return, highest return. When we say risk averse person, he's happy with whatever he has and he doesn't want to take much risk. He is a conservative person. So he is always the person who would like to go for highest return among the least possible options. Okay, the best return among the least possible options. Risk neutral person is the person who is neither too expecting too high returns, not expecting too lower returns. So he is in a moderate position. He is generally expecting to cover up his opportunity cost. So he is more looking from that, let me cover my opportunity cost. Okay. So now, how to counter uncertainty? For this factors, we have market surveys to counter uncertainties. We have questionnaires. We take the customer interviews. We have small groups, for which we conduct their interviews and get the intent of the people. We raise questionnaires. We distribute samples and get the feedback. So by this, we get to, know the attitude of the customer, and thereby when you're launching the product, you launch the product considering these factors, so that there is minimum risk, or the risk is minimized once the product enters the market. Now, generally the examinable methods for your exam is expected value method, decision tree method, value of perfect information, maximax, maximin, maximax, and minimax regret methods. Let's take them one by one. First is expected value method, which is generally preferred by the risk neutral person. So like I told you that we will always take probabilities for the different situations, multiply them and get the expected value, that is the estimated value considering all the uncertainties, so that we are able to account for these uncertainties also and be at a very neutral category. Now, what can be the different advantages and disadvantages of using this expected value method? I think the major advantage is it is very easy to use and calculate. And another advantage can be that here we are not just depending on any one figure and one estimate. We have different estimates, different probabilities, and with which you can derive at a very moderate figure. And the disadvantages are that they are difficult to assign probabilities, because with surety we cannot say that it is exactly 40% chance. It can be 50 also. So these probabilities can always change. Then it is highly subjective. I think so it's the biggest disadvantage for this method. Second is value of perfect information. That simply means that what is the value of perfect information? What is the cost, or what is the value of obtaining the information without any errors, without any mistakes, and this perfect forecasting to be done. If I say 100, my sales is 100 only. So that is the perfect information. How you can derive the perfect information? It simply means how much cost the entity should bear to derive this perfect information. So this be calculated as expected value of perfect information you will get, and from this you will reduce expected value of imperfect information. So the answer that you get is the value of perfect information. That means this is the maximum cost that can be incurred by the entity to obtain the information perfectly, accurately. How do you calculate the expected value perfect information? You take the perfect scenarios. Like in the worst conditions, what exactly would be the sales amount. In the best condition, what exactly would be the sales amount. And then on that, you calculate expected value. When I say imperfect information, we don't know in worst what will be the perfect sales. So in worst condition also, I have three outcomes and I take expected value of all three. So too much of probabilities are involved there in imperfect information. Clear? Again, advantages and disadvantages. So it is error-free, perfect estimates that removes risk of uncertainty in the future, but it is very difficult to obtain. And if the cost is more than the benefit, then there is no use of trying to obtain that perfect information. And then everyone should work with the probabilities only and try to get an average estimate, reasonable enough to work with. So it is very difficult also to calculate this perfect information because situations change a lot in the future. So it's very difficult to take care of all of them and it's expensive also. Now decision tree method is simply that you have decision trees and then decision trees are created from left to right and then from right to left we solve them. We use probabilities to solve them. Two important pointers to note that whenever you have to take a decision, it will be always square box, and whenever you're doing any calculations like probabilities calculations, then always you're doing in the circular box. So make sure that you don't forget them. And decision trees are never to be drawn by you in the exam. They will be given to you. You have to apply the expected value method to solve it. Advantages same like expected value method, very easy to use, and disadvantages same like expected value method only. So the same disadvantages because of probability that exists, same disadvantage will exist for decision tree method as well. Okay, now I come to one of the most important areas, which is maxi-min and maxi-max and mini-max regret. How you should be reading it in your exam is always right to left. And you will never do errors. When I say maxi-min, he is a risk-averse person. Because what he will say, right to left, he will look for minimum returns from all the options like worst option, best option and the moderate option. He will look for the minimum return from all options. Now out of those minimum returns, which is the best return, he will choose that. So you will choose always maximum of those minimum returns. So always read right to left and you will never be, faltering. So risk averse person, for him it is this method, minimum returns of all the methods, all the situations, all the outcomes, and of those minimum returns choose the maximum, that is the best return, the highest return. Okay. Maximax, again right to left, he would look for maximum returns from all the outcomes and he would go with the maximum of those maximum returns, the highest of all, because he's a risk taker, so he would go for highest returns. Risk neutral person, like I told you, he would always go on to make sure that his opportunity cost is covered. So always read it right to left. Right is maximum regret. So step 1, calculate the maximum regret. Regret is because we are going for the next best alternative. What is the regret of not choosing the best alternative? Okay, so what is the opportunity cost for that? Calculate that maximum regret. Now, of course, a risk neutral person would like to minimize it. So then out of all these maximum regrets, let's minimize those regrets. So he would go for that option that will give him the minimum of all the maximum regrets. Minimum. Okay. So don't forget maxi min, read right to left. Maxi max, same. Mini max regret, go for maximum regret, and of all those maximum regrets, get the minimum of them and you get your answer. So here I have taken an example. Order size is 20, 40, 60. Demand is 20, 40, 60. There are probabilities based on which I have calculated the payoff. This is the payoff table. Payoff is a profit table. It's a profit table. Now when I say is the maxi min, for all these options, please select the minimum. Here minimum is 15. For 40, the minimum is 25. And for 20 order size, the minimum is 10. 15, 25, 10. The minimum is 10. So he is a risk, the minimum is 10, but he is a risk taker and risk averse person. What is the formula that we use? Minimum, and from all the minimum returns, he will choose the maximum of that. Okay, so what is the maximum return of all that? 25. So he would go ahead with 40 order size. When I say max, the maximum here is 42, here 35, here 10. So the most payoff or the most profit is expected when we manufacture 60 units. So the max person is a risk taker. He would go for this one. That is, he would go for 60 units. Now the third one is minimax regret. So for that, always remember that you have to prepare the regret table. This is the regret table that is based on the order size. Let's say here, for example, what is the maximum return for this sales? Maximum profit is 25. So here the regret is 15 and here the regret is 10. So like this, you will prepare the regret table. Of all the regret tables, get the maximum regret. Now, obviously supply wise. Supply wise maximum regret is 10 here, here 7, here 32. He would go with minimum of these maximum regrets. Minimum is 7, so he would go for 40 order size. Clear? Now the last is in risk and uncertainty. It's a very important technique to handle uncertainties is going for sensitivity analysis. That simply says generally sales is the base that we take for P&L. So we will check the sensitivity of each product to the sales. The product that has got the least sensitivity or the percentage change will be the most sensitive product. Why? It would mean that even a small change in percentage, a small percentage change in sales will bring about a big change in that particular item. So hence that product is the most sensitive of all the products. So now elaborating it here, when we say we go for sensitivity analysis, we are just looking into what if analysis. That simply means what if there is a change in the input variable and due to which the output is affected. So you have to understand which is the input variable due to which your sales are affected. It simply means, let's say if my advertisement is 20%, my the sensitivity analysis it is 20%. So that would mean that a 20% change in advertisement will bring about a change in sales. So that means the product which has got least percentages will be the most sensitive product, because that is the product with the least percentage also it's bringing a big change in the output. So it helps the managers in decision making. Now just few pointers to remember. The variable, the change of which is that variable. Okay, that variable, the change of which is resulting in the change in the output with the lowest percentage is the most sensitive variable for that output, as a small percentage change can lead to big changes in the output and therefore it is the most sensitive of all the variables. Yes. Done with risk and uncertainty. Let's move on to the next one. The next topic that we are taking up is pricing decisions. What is the major aim for a pricing decision? What do we focus on here? So we focus on how to set prices for the products and services so that we optimize the business performance. It simply means that how would we set the prices for the products and services so that the cost is minimized, profit is maximized, and overall it's a win-win situation for the business. Okay, now so here we talk about demand and price elasticity as the first point. What does it mean? We know that the price is inversely related to the demand. That would mean that if your price increases by 2, your demand decreases by 10. For example, here we can see here if my price increases to this point, then the demand is where the price is increasing. Okay, then the demand you can say is reducing. At this point the demand was maximum at price 0. Always remember, at price 0 your demand is maximum. So at maximum demand, but as my price increased, my demand got reduced. As it further increases, demand gets further reduced. Okay, remember this relationship and remember this relationship also for your exam purposes, that at price is equal to 0, your demand will always be the maximum, and price and demand are always in inverse relationship. Equation of the demand is this is the basic equation, a by default equation that you cannot afford to forget, is P is equal to A minus BQ. But don't worry, ACC is going to provide you this in the help section. So even if you forget, refer over there. And here A is the, like I told you, it is the maximum price. Okay. So basically here I told you that this is the point where your demand is maximum if your price is 0. Now you can say at the price 0, if my price is maximum, my demand is 0. So A is nothing but that maximum price that we call as theoretical maximum price, because typically we don't reach out that situation generally. But yes, it is the theoretical maximum price where your demand is 0. So A is that point. Okay, A is that point, that is we call it as maximum price. Let me repeat it again. It is the maximum price at which the demand is 0. And B is known as the slope of this line. So that is basically what is the change in price as a result of change in demand. And this is not in percentage, my friends. This is in absolute terms. Now, how do we calculate elasticity of demand, which is presented like this? Elasticity of demand is simply what is the percentage change in demand as a result of percentage change in price. Okay, so yes, it is opposite. It is not B. It just measures the price elasticity. That how much elastic is a product towards the change in the other variable. That simply means the percentage change in demand due to the percentage change in price. So if my price is changing by 10%, demand increases by 100%, or that price changes by 10% and demand increases by, let's say, 20% only. So now here, how do we determine it? It basically means, how do we determine elasticity? Please look here. Elasticity, now that means that your demand can be elastic or inelastic. If I say my demand is elastic, it means that a small change in the price will lead to a bigger change in the quantity. A small change in price leads to bigger change in quantity, and that is your elastic demand. Inelastic demand means basically a change in price may or may not bring a change in the quantity. Okay, or if even if it is bringing, it's like a small change. For example, if the price of a designer bag increases, and the customer are most likely to buy the cheaper alternatives. Not everybody would go for the designer bags. Price of essential goods or medicine changes. Okay, a strong brand loyalty, for example, with iPhone is there. It will really not affect the demand, because if you have to buy the medicines, you will buy the medicines. So it won't really affect your demand. Now, what is the optimal price? Optimal price is what is tested in your exams. So optimal price is the combination for both cost and price, or cost and demand equations. It simply means by making the use of the demand equation, optimal pricing can be achieved. So it is so that at the selling price, the short-term profits can be maximized. Remember that pricing also focuses on the short-term profits only. So it is that point where the short-term profits can be maximized. So what is that point? What is the point for optimum, at which your profits are maximized, and that we say is optimal pricing. So we would like to fix that price where my profits are maximized. So now here I will equate cost and revenue, cost and demand equation. That means I will calculate marginal cost, that is the variable cost of producing the product, and the marginal revenue. That simply means what is the incremental revenue of selling one extra unit. And that is represented by A minus BQ. Now, equation of demand we have already discussed. So now it is marginal revenue, like I told you, it is simply increase in total revenue as a result of selling one extra unit of the product, that is incremental revenue. Marginal cost is similarly increase in the total cost as a result of producing one extra unit. Okay. So in order to sell one extra unit beyond the units which is demanded at a particular selling price, there is there is a need to reduce the price for all units henceforth, which will reduce the overall total revenue. Okay, and for simplicity, assumption is that MC is equal to VC, variable cost that I told you, per unit till full capacity is utilized. Generally, it is the constant price only, but the cost per unit will reduce once any volume discount is given. That simply means that, till the level of capacity, you will get your normal cost, but beyond capacity, when you want to produce, you get volume discounts, you get economies of scale. So you have a production cost which gets reduced. And then, of course, if you want to sell beyond the maximum demand, let's say the maximum demand is 10,000, and you want to sell one additional unit beyond that demand, then of course you have to reduce the price, because only then you will have takers, because you have reached the maximum demand. So marginal revenue represents that, and marginal cost represents for the cost column. For you to remember in the exam is this equation at which your price and the profits are maximized, which is MR is equal to MC. MR is equal to same demand equation, but here we will use 2BQ. Here you will use the term 2. And MC is simply variable cost per unit. So when I say MR is equal to MC, it simply means you're equating variable cost per unit with A minus 2BQ. Okay, now, so the point is, how would we maximize? We have to profit maximization. For that, you need to identify the quantity at which the profits are maximized. And when you solve this MR is equal to MC question, first step is get the values of A and B to create the MR equation. And then when you equate MR is equal to MC, get the Q. Once you get the Q, put it in the demand equation and get the price. So these are the steps that we follow. Okay, now I'll discuss just one more point, which is volume-based discounts. Volume-based discount is, let's say that an entity is offering that if you buy in volume or if you sell in volume, they're asking for discounts, and you feel that giving the volume discount is a very profitable thing. But is it or not? For that, we have to do some calculations. So steps to calculate whether the volume related discount is financially viable or not. What are the steps that we undertake? Step 1, calculate what is the increase in total sales due to selling that extra units. Okay, that is what is the revenue before and after the volume discount. Step 2, calculate the increased cost. Likewise, the difference between the two is the change in profit. So if your revenue has increased more than the increase in cost, it's viable. If your revenue is not increased more than the increase in cost, then it's not viable financially. So let's take an example for this. Let's say that a company sells a product at a price of 10 per unit. The variable cost per unit is 4. Volume discount offered is 5% for buying at least 5,000 units a year. The customer will increase production from 4,000 to 5,000 per unit. What is the effect? What is the revenue before this decision? Revenue was 10 multiplied by 4,000 units. Okay. But now the revenue has reduced to 9.5. There is a 5% discount on 10. And the quantity has increased to 5,000. So incremental revenue is 7,500. Now, what is the increase in total cost? Earlier, the cost, that is the variable cost, was 4 and the quantity was 4,000. Now you will have a reduction there. So the quantity has changed from 5,000 to 4,000. Variable cost is same per unit at 4. So the cost increases by 4,000. As if you can see, the incremental profit is 3,500. So it is positive, it is a profit. So we should go ahead with this volume discount and give a thumbs up that yes, this volume discount will be undertaken. Now let's discuss the different pricing strategies for an entity that can be adopted for fixing price. First is the full cost plus margin method. Full cost plus margin method is more from the long-term planning option. That simply means the price of the product will be total product cost plus profit markup. and markup is always on cost. Okay, so now total profit cost plus profit markup. The next is marginal cost plus pricing. Marginal cost is the variable cost. So here pricing of the product will be variable cost, which will be both production and non-production, because we'll take marginal cost, which will be both production and non-production cost. With this we add the profit. Third is return on investment pricing. So this method is again for long-term planning purposes, and here price of the product will be with the full cost. You will add the return on investment on that particular project, or the amount invested into the capital of the entity, capital investments. Okay, capital employed, you can say the capital which has been employed on the business, that is a non-current assets. What is the return earning on that? Okay, so that you will add with full cost and not the profits. Next is opportunity cost pricing, that simply says get the relevant cost plus markup. Relevant cost is the opportunity cost, right? It is the minimum price that can be used as a basis for quotation. Simply here when we say the price of the product, we always call it for the incremental cost. It is that price that we have to cover in order to manufacture the product. So the other costs, which are like allocated costs, for example, the fixed cost and all, we don't consider them. We only consider the relevant cost, that is the incremental cost, the cost which is needed to manufacture these products. Only that cost we take, and with this we add markup. So yes, we can say that opportunity cost pricing gives us the minimum pricing that a product should be priced at, and we cannot go below it. Life cycle cost pricing is when you price the product based on the life cycle cost. On that you add markup. Now let's move on and let's understand about the different pricing strategies. Not understand, revise about the different pricing strategy. First is market skimming. Best example I gave can be iPhone, that is they enter the market with a very high price, with the aim to get the maximum profits in the first few months of the life cycle only, or the few periods of the life cycle, because we know now products have a shorter life cycle, so the aim is to maximize the profits within that short period only. Okay, so it is more aiming for short-term profit maximization, and in the later stages the price gets reduced, and so it is stabilized, and the profit gets accordingly calculated in the later stages. Market penetration is like geo, where you enter the market with a very low price to grab the market share, probably give a very tough competition to the competitors. So the aim is not to earn profits early in that life cycle, but spread out throughout the life cycle by increasing the number of units. So they enter the market at a low price. Price discrimination example can be tickets at tourist places. You can see when you go to the tourist places, we have differential pricing for foreign tourists, for senior citizens, for children, and for others. So this differential pricing is price discrimination. That means the practice of charging different prices to the different categories of the customers. Complementary product pricing is like razors and blades. That means the cost of one, the pricing of one product, these two products are related to each other, like computer and printers. If you don't have computer, you cannot have printers there, right? So it is basically the use of one product is linked with the purchase of the second product, and hence sometimes the main product is charged at a very low price, but the complementary product, the other product, the other product which is linked to this product is charged at a very high price. Okay, because that is to prompt the customers, and the profitability is main earned from that complementary product only. Like ink cartridge and printer also can be the example. Now product line pricing. So when I say product line pricing, it simply means, let's say for example, there are meal deals. When you go to McDonald's, you go to your KFCs and all, your meal deals. The meal deal is basically means if you have a reduction in the pricing, and the pricing policy is applied not just to one product but to entire products of that range, of that category, which are related to each other. So for example, setting differential prices between the different products in a range. Like basic prices charged for a basic car, but as you enhance and you go to the increased versions of it, the better versions of the car, you get higher price charged. So that is in the same product line only we have differential price charged. Then volume discounting. Volume discounting is, for example, you buy one and get the next one at 50%. And many times it happens that you buy two and you get loyalty discount. So this is a promotional pricing. That means you prompt the person to buy more and thereby increasing your sales, which eventually ends up also giving some discount, but that is not really affecting the sales and the profits at all. Then we have loss leaders. Loss leaders are very, very frequently asked in exam, like supermarkets. So one, for example, that you see an ad which has shown that a particular product is now at 90% discount. That means it may be probably selling at a loss. You go to the supermarket to buy that product, but what happens is along with that product, you buy many other products as well, and where the prices are not that slashed. So the entity, the business, yeah, so you end up actually buying more products, and which is where the entity actually, the supermarket actually makes more money. So this is like attracting customers for one product, which eventually ends up them selling 20 more products. So this is known as loss leaders. Now, going rate pricing is like your airline industry. I think I can give this example where they charge the price which is prevailing in the market. Like when you go and buy gold jewelry, you pay the prevalent gold rates. So in the competitive markets, no, you cannot charge above than this. Even if you charge above than this, it's not that it will attract more customers, and in fact the customers will be lost only. When you charge below than this, then also it is not going to attract more customers, because people are, they are indifferent to that price increase or decrease, because it's all prevalent prices that they are ready to pay. For example, your fast food industry, your telecommunications, e-commerce, we follow these. Like Amazon, Flipkart, we always follow this, the prevalent market prices. So now if I can just quickly give you a summary of steps to be followed to find out what is the profit maximization selling price. Step 1, formulate the demand equation, which is P is equal to A minus BQ. Step 2, formulate the marginal revenue equation, which is P is equal to A minus 2BQ. Step 3, calculate the marginal cost, which is equal to variable cost per unit. And you equate MC is equal to MR and find out quantity. Put that quantity in the demand equation to find out the profit maximizing price. So we are done with pricing. Now let's move on to the next one. Now let's discuss relevant costing, that we also call as short-term decisions, which is the topics that we cover under this relevant costing is opportunity cost, one-off contracts, shutdown decisions, make or buy decisions, and the further processing decisions. What are relevant costs? Simply speaking, like we discussed in the last topic, it is the cost or revenues which are affected by a particular decision of the management. It simply means if you undertake a particular project or you do a particular decision, then these are the costs that you can avoid. And avoid would be the cost that, if you do not take the decision, you do not take that project, then what are the costs that you can avoid are the relevant cost. The cost that you cannot avoid, like a portion fixed cost, are not the relevant cost. Okay, for example, fast food connections like McDonald's or Domino's, they often accept bulk corporate orders at a very low price. It's because they only look for the variable cost to be covered, as well as if there is any opportunity cost that they are losing, they also try to cover that. And then they don't really look for fixed cost to be covered, as it's a sunk cost, the cost that has already, taken place in the past, incurred in the past, and it's a cost that as it is will be allocated to other products as well. So this is not a relevant cost, hence they do not consider that, based on which they determine the price for these extra orders that they get. So what are relevant costs? Typically, if I summarize, the cost which is future oriented, which is having a cash effect, like which can be which will result in a cash outflow, which is incremental cost, which is specific cost like specific fixed cost for a particular project, and which is an opportunity cost. Opportunity cost is simply the cost or the contribution that you're losing, because you're going for the next best alternative. You are not taking decision A, but you're going with decision B. So the contribution that you're losing for decision A will become your opportunity cost. So now based on which, what is your non-relevant cost? The cost which is not relevant is like the sunk cost. Sunk cost means the past cost. Like the cost that you have already spent in the past is your sunk cost. Committed cost is the cost for which you have committed already for it. Like a long-term materials contract maybe to supply. So that long-term contract is a committed cost. Notional cost is like depreciation, which is a non-cash cost. And the fixed cost we already know. And since it is not incremental, hence it is a not relevant cost. Okay, now when we see here, now let's look at the exam focus point, the main focus point that you have to ensure that you don't forget in your exam. Explain why you have calculated the relevant cost in that way, as well as why you haven't used certain numbers. So this is a pointer that you have to remember whenever you are asked with relevant costing. Always you have to just do two things. Number one, why have you taken a particular cost as a relevant cost? And number two, why the other cost that you not have taken as a relevant cost, why you haven't taken them. So give reasons for both in the exam to get the marks. Now let's have a quick summary of what is the relevant cost for materials. For materials, the relevant cost will depend upon whether the material is in stock or not in stock. When the material is not in stock, you have to buy that material from the market. So the relevant cost is the current replacement cost, CRC. Here I'll just quickly make you understand these three terms before I take up more pointers. Current replacement cost is simply your current market value. That means how much it would cost now to get the same benefit as this asset. So what is the current market value of this equivalent item is your current replacement cost. Next, what is the current resale value? It's tell us what someone would pay for the asset that you want to sell today in the market. So the asset that you want to sell today in the market, what is its current resale value? In the same condition, same location, what is the other person ready to pay? Opportunity cost, like I've already explained to you, it is the benefit that we lose by choosing one option over the another. It simply means your lost contribution. Always remember it as lost contribution. So now when your material is not there in stock, you have to buy it from the market and replenish it and get it to your stock. So you will buy it at current replacement cost. When your material is in stock, now it depends upon whether your material is regularly used by other products of the companies as well or not. If it is regularly used, then you need to replenish the stock and you would do it at the current replacement cost. When the material is not in use, okay, when the material is not in use and so it is probably available to be sold, resold, when the material is not in use, then the entity would like to resell it. So the relevant cost will be the current resale value. Third is when the material is in short supply and now you have to shift the material from the other product to this product. So what is the entity losing? Contribution. So the relevant cost will be that lost contribution or opportunity cost. Let's go on to the relevant cost of labor, variable labor or the other variable overhead. Same rule, same clause, understanding. Now that will depend upon, because variable overheads is also dependent on labor hours only generally. Now that will depend upon whether your labor is currently has spare capacity or not. If your labor currently has spare capacity, then the relevant cost will be zero. Because already your labor has idle time and he has been paid for the full hours. So if he has, let's say, total 8 hours for which he is paid for, 5 hours he's working, 3 hours is free. So if you're getting him work for those 3 hours, it's zero relevant cost because he's already paid for it. If the labor is currently at full capacity, then two options with the entity, either to buy new labor from the market. In fact, I would say there are three options with the entity. First is to buy new labor from the market, so the relevant cost will be the current rate of pay. What if the entity cannot buy new labor from the market but can make the existing workers work at overtime? So now if the company is making the existing workers work at overtime, so the relevant costing would be the normal pay plus overtime premium. That is overtime pay. Correct? Third is when there is no overtime available, we cannot hire from the market also, and we have to switch labor from one product to another project. Then the relevant cost will be opportunity cost, that is a lost contribution, plus the current rate of labor. Because of course, when the labor is going to work henceforth, you have to pay it. So the current labor rate, which is the variable cost, plus lost contribution will be the relevant cost. Next is relevant cost of machinery. So when there is a machinery in use, always the relevant cost will be the use charges, like the repair cost, like the hire charges, like fall in the resale value arising from the use. Okay, and it can in fact be the future income also that is arising from the machinery. So all this is relevant, something which is going to happen in the future, like the repair cost, like the hire charges, like the fall in the value of the machinery, because you are not selling now, you are selling after a year after use. So the value that has fallen is the relevant cost. In fact, the future earnings that can be related to that machine can also be the relevant cost. Now, some exam scenarios which are frequently tested are like the minimum pricing decisions. Minimum pricing decisions typically focuses on variable costs. So here we look for that minimum price without having any profit added to it. So what is that minimum price based on relevant costing that a business can charge at which we have no profit, no loss? So that's the minimum. Accept or reject decisions. It's basically again we check for the relevant cost and we accept the project if it gives us the positive return, and we reject it if it gives you negative return. That means incremental revenue is more than the incremental cost. That is, your profit is positive. If it is a loss, then you reject it. Make or buy decisions, few points to consider. When you have a decision to choose, like whether we should make it in-house or buy it from the outsourced person, that supplier, then few points to consider is how to use the spare capacity properly, which is now spare because you're outsourcing it to somebody else. Could the quality of the product be affected if that product is outsourced? Would the delivery of the goods be on time or not, because your customer will be dissatisfied because of it. So does the company wish to retain control, because sometimes it can lead to control dilution also if the our product is outsourced. Other factors that can be considered apart from financial factors, very important for your section C questions and section A questions here, because generally we focus on financial factors. What about the non-financial factors, like the impact on the workforce of this decision, whether their sentiments are positive or negative, customer satisfaction, especially with regards to delivery and quality, inflation impact, the suppliers resources, suppliers capacity, suppliers technical position, suppliers funding, all this will affect. When we take outsourced decisions, it simply means that getting help from outside the organization, and we are hiring the external suppliers for doing some activity for that product. Okay, so simply what we actually compare is, let me give you a summary. What we compare in these make or buy decisions or outsourcing decisions, we compare the variable cost of making the product in-house. Okay, so we compare variable cost of making the product in-house with outsourced price offered. With the core purpose that the outsourced price offered, if it is more than the variable cost, then definitely we'll make the product in-house. If it is less than the variable cost, then we will outsource the product. Shutdown decision is basically decision relating to whether a closure of a product line or a decision line division should take place or not. So few steps. So for these shutdown decisions, entities focus should primarily be on the variable cost. Okay, that is whether the variable cost is getting covered or not, the avoidable cost, directly attributable cost. If the question is, if the closure is made, what is the directly attributable revenue and the cost, and what is the timing of closure. So timing of closure would mean that is it getting closed at a time when the other divisions are at peak, and this closure can affect the sales of other divisions. So that relationship also we have to check. Last is for the processing cost. Here we focus the relevant cost would be only relevant to that further processing, that whether the product should be further processed or not. So we simply take the difference between incremental cost and incremental revenue. Incremental revenue is a difference between the split of point revenue and the revenue after the further processing. And incremental cost is the further processing cost. So if your revenue is more, incremental revenue is more than the incremental cost, then go for further processing. Simple decision. Joint costs are sunk costs, so that we don't take it. These are ignored. What are the assumptions in relevant costing that we take? That cost behavior is in a predetermined pattern that we follow. CVP are known with certainty, and always the aim of the business is to maximize profit. I think that's the basic aim that a business carries. Let's go to the next topic. Let's discuss the next topic, which is budgetary systems. I've highlighted here section C because generally every section C question has a bit of portions always coming from these budgetary systems, budgets, and standard costing. Now, budgetary systems always talk about typically that every entity has a mission, and based on that missions then we drill it down to the long-term plans, which is like the strategic plans and covering the strategic objectives of the company, based on which we create the annual plans that we call as budgets. So budgets are like the third in this hierarchy. Okay, in fact over mission there is a vision of the company as well, the overall aim of the company, that why the company is into existence. So you can say step number 4 it is. So budgetary systems are a task of the middle level of the managers, that is the middle level of the management, the tactical level, and the preparation of these objectives, that is we discussed here the long-term plans. So long-term plans is the objective of the strategic level, that is the top level of the management. And the middle level focuses on preparing these budgets and we ensure that these are implemented by the operational team. Budgetary system is a series of steps to achieve control over the financial activities of the entity. Let's quickly see what is the purpose of budgetary system. Remember it like crumpet as this mnemonic, because many times when it is asked in MCQ, you tend to forget. Students tend to forget. So I've given them a mnemonic crumpet. C means coordinations. The budget should have coordination. R means responsibility. Responsibility should be fixed for the budgets. Who is responsible for what area? U is utilization of resources. M is motivation of the people, employees, managers. P is planning, which is a core purpose of budgeting. E is evaluation of the outcomes, the controlling process. T is telling, that is communicating it with the people who are implementing it, communicating it to the right person, you can say, to the implementers as well as to the ones that who are, to ensure that the management also have a check on the budgets, so that they know that their targets or the strategic objectives are in line here. Now going forward, so what is the role of budgeting in the long-term planning? It helps in establishing the long-term corporate objectives. It helps in producing a specific plan, which is the annual budgets. It produces a sales forecast. So from annual budgets, we create sales forecast, and then based on sales forecast, we create other budgets. Functional budgets are prepared. Okay, and so sales budget is generally known as the master budget. That is, kind of the budget that will be having the sales forecast, the balance sheet, P&L, everything is there, and based on which we prepare the functional budget. So here master budget is the overall budget, and then we prepare functional budget. First functional budget that we prepare always is the sales budget, based on which other budgets are prepared. Then we compare the budget with the actuals and take the necessary actions to ensure that there are no variances variances are reduced if they are negative. Sustainability and ethical budgeting, they go hand in hand. We have discussed about sustainability as well. So just taking a small pointer for sustainability here, that budget should account for sustainability points as well when we are preparing the revenue and cost estimates. For example, there are carbon emission reductions. If they result in savings, then that can lead to incremental income. So that has to be highlighted. If they're installing a pollution equipment, that leads to incremental expenses. Again, that has to be highlighted in the budget separately for sustainability. Now, what is the relationship between planning and budgeting? Plans are the targets, and then we match it against the actual performance. We find out variances, and we take actions to control these variances to ensure that the risk is mitigated and they are minimized. If there's an adverse reasons, we look for adverse variance, we look for the reasons for the same to control it and correct it. If there's a favorable variance, then also we look into it, that whether the results are accurately corrected, calculated or not. For that also we look into the favorable variances as well. Now it comes the next point, that what can be the feedbacks obtained when we are doing this controlling action. There can be negative feedback, which is the adverse variance. There can be positive feedback, which is like the favorable variance. And then there is another term that we use, feed forward control. Feed forward control is simply the future estimates. That is, what controlling action can we take for the future estimates well in advance. So how can we control those future changes also well in advance is your feed forward control, feed forward control, right? Now, one more understanding for the feedbacks. So when we adopt the controlling actions, there are two types of feedbacks that we can have: single loop feedback and the double loop feedback. Single loop feedback is basically, now when an entity thinks that, let's say there's a difference between actual and the standards, and entity has a reason to believe that the difference is only on account of poor performance actually. So that's a single loop feedback where we don't make any changes to the standards or the budgets. But when we come to double loop feedback, now here again we have variances, and then the entity thinks that the variances have been maybe consistently negative or adverse. So that makes the entity to think that maybe the standards were set too high. Like we have the four types of standards: basic, attainable, ideal, and the current. So maybe the standards set were ideal budgets and not the attainable ones. Okay, so due to which the variances are too high. So then the management needs to reassess the standards and probably update the standards. Okay. Now let's see the different methods to prepare the budget. First, I'm taking this top-down budgeting and bottom-up budgeting. Top-down is also known as authoritative budgeting, and bottom-up is also known as participative budgeting. Because top-down budgeting simply says that the budget is prepared by the strategic management and which is communicated to the lower levels of management. So they really don't have a say in this decision making. Okay, and participative budgeting is where all the departments, all the level of the organization, top, middle, and lower, all three are a part of the budget setting process. So of course it's time consuming, it's lengthy, and we generally recommend this top-down budgeting when the economy is probably having tough time, it is a new company, and the staff does not have much experience or the technical understanding that they can prepare the budget. So now here I'll be giving you some instances which you have to remember for your MCQ questions. Typically when we prefer the top-down budgeting, and even in section C, a 2-3 marks questions can be asked on it. Like some instances when top-down budgeting is preferred: number one, when there are disturbances in the economy and so there is financial instability. Then it's a startup entity and it's like the early years. Certain areas like fixed assets are preferred always to have the top-down approach only, because it's in the investment amount involved is huge, and it really not covers just a department or just a division, it covers the entire organization. And the required levels of skills are missing with the junior managers, and there are too much dependencies there between the departments. So due to which the senior management now needs to step in. Okay, now one of the reasons why we discourage participative budgeting is because the existence of a budgetary slack. Budgetary slack simply means that the managers, they try to act smart and they basically take up the figures of the previous year and they add a percentage and get this figure approved. Even though in this year they know that the expenditures would be less. So they do a slack because if their performances are evaluated based on the budgets, then they always prefer that they create budgets with high expenditure and actually they incur low expenditure and present it to the management that it was a performance that they are delivered, that means improvement in the performance, and that is giving rise to favorable variances. When actually it was always supposedly this figure only that they have achieved actually. So just because they artificially increase the budget, they are trying to ensure that their bonuses are good and they get heavily rewarded by showing favorable variances. So this is also one of the reasons why sometimes participative budgetings are discouraged. Now, practically the organizations will always apply both the types of budgeting as a combination. Now, the second type of budget, which is again very popularly asked, are rolling budgets. They are also known as continuous budgets. So just remember, let's say if I have 4 quarters in the year, if one quarter of the quarter one of year one is now over and we have actual results, based on these actuals, we will change the forecast for the coming 4 quarters. First quarter will be quarter 2, second will be quarter 3, third will be quarter 4, and now new quarter 1 of year 2 will get added. So like this, we will always have these 4 quarters data, always estimates will be available. The best part is that you can continuously update the budget that is based on the actuals of quarter 1. The budgets of quarter 2, 3, 4 and the next quarter can be updated. So it is not that we are carrying the same budget targets only for the full period. So now here I have given the steps in summary. Recreate the budget by adding 1 quarter at the end when actual takes place for the earliest quarter. Recalculate the target or the forecast based on the actual performance of the quarter that just got passed or that got completed. Next is incremental budgeting. That's a simple approach that says it's the most commonly adopted and the most easiest method for budgeting. In this method, we take the current year budgets or the actual results, whatever is the case. Maybe typically we take actual results only as a base. And on this, we apply a percentage increase or decrease that the managers expect the expenses to go up or go down. Okay, and it is taken into account the expected growth based on inflation. It is generally used or recommended for processes which are well established. Okay, it is generally used or recommended for processes which are well established, as well as which are efficient and involving no changes. Of course, if they involve a lot of changes, they are inefficient, every expenditure has to be justified, then incremental budgeting is not relevant. It is generally relevant for the expenses which are recurring and which we do not expect much changes to be there. So it is more relevant for a stable organization. Next is activity-based budgeting. We know activity-based costing. So when an organization applies activity-based costing into its budget also, then we call it as ABB, activity-based budgeting. Simply it means to apply the cost information derived from ABC as the base for budget preparations. Managers, they need to have controlling role for the cost drivers, and ABC can only be applied in the entities only then if ABC is applied in the entities, only then ABB can be applied. Otherwise, ABB can never be applied if ABC is not already followed as an overhead allocation method. Simply, it is the same only, but when it is a part of budget, we call it as ABB. Zero-based budgeting, one of the most important pointers. ZBB simply says, boss, start everything from scratch, give a reason for why we are including a particular expense. So validation has to be done. So it starts from scratch, zero level only. Every expense or cost inclusion has to be justified. And we always do start fresh. We don't follow incremental budgeting here for ZBB. That is, we don't rely on the past data. The steps in ZBB is step 1. Identify the different activities. Number 2, preparation of a decision package for each of the different activities, the decisions relevant to that activity. Decision package is simply that you are evaluating and validating the rank and also ranking the decision packages. simply means that if you want to take a particular expenditure, all the alternatives, we simply calculate them, rank them, and then we take that expenditure in the budget. Generally, it is done by the budget committee and approval is given by the management. Resources are then allocated to the chosen alternative or to the chosen expense. Finally, the decision is created. Generally, a decision package will include 3 pointers, a base package, which is a mandatory point, any other incremental package like 1, 2 are there, and we choose the alternative. Let's say we go for a car purchase. So the car purchase is a basic package. Accessories that we add on becomes your incremental package. So then we see the validation whether the certain accessory is actually needed or not. Accordingly, that budgeting will recommend to go for incremental package 1 or incremental package 2. Now let's take the last topic here for budgeting, which is beyond budgeting. It simply says that the managers now need to look beyond the normal budgeting or the traditional budgeting approaches. The management should think out of the box and come out of this orthodox zone. So they should look beyond the normal budgeting processes. That means don't consider budget as a one-time process or a past process only for a year only. Okay, consider it to be an ongoing process. The principle here is to use adaptive management processes rather than limiting to the use of fixed annual budgets only. The other areas that we think fit that goes beyond the budgeting, looking into the non-financial angles as well. Okay, that is now the quality of the management that looks beyond these financial numbers that we are putting in the budget. So that says look beyond these financial numbers. Let's go to the next topic for further revision. Now the next topic is, I think, the father of all topics when it comes to the relevant topics for section C, that is advanced variances. All of you having questions about ma'am basic variances, then please refer to the video that I've already uploaded on my channel for detail about basic variances, where I've taken every basic variance with detailed questions. So please follow the video for the same. Now going for the advanced variances. So here advanced variances would mean that you are going beyond the basic variances. So here typically we'll be focusing on material and sales variances only. You know that for material we calculate under the basic variances price and usage variance. Now we are further categorizing or detailing the usage variance into material mix variance and material yield variance. Likewise, the sales quantity variance, we will be detailing it into, or the sales volume variance, we will be detailing it into sales mix variance and sales quantity variance. What is this all about? It simply means when I say it's a mix variance always depict what would be the variance if there is a change in the mix. Mix is the proportion in which the material is to be used in the production of a product. If we change that proportion, let's say the standard says to use both the materials equally, and now we are using actually it in the ratio of 6:4. What is the impact on the variances due to a change in the mix? Second is the yield variance. It simply means, yield always means how much input can generate the output. So yield variance discusses about how much is the output generated from the input when it is used in the way that the standards recommended. So in the ratio of the standard mix, we see what is the actual input going to be, what is actual inputs if it is used in the standard mix, and what is the standard input if it is used in standard mix. So whether my expected input is more or less than the actual input. If we are using less input, it's a favorable variance. If we are using more inputs actually, then it's an adverse variance. Okay, and we can always check it from the output method also by focusing on that whether the quantities that we are required to make or the actual units that have already been produced. If what were the actual units to be produced if we had used the standard input, and versus what is the actual units actually produced based on actual inputs. So look here, these are the formulas that we see. We always take the tabular method. I recommend personally to follow the tabular method. It's the easiest and very easy to remember, and I think very easy to control. Whereas the material mix variance, focus on mix, that you are going to take the difference between the mix, standard mix and actual mix. and you will use always actual inputs. So first column is for each of the product, calculate what is the actual quantity used for the actual inputs for each of the materials. And likewise, in the next column, we will prepare actual quantity in standard mix. The same inputs, so same actual inputs, now we are going to arrange them in the standard mix. Get the variance, and always you will multiply it with the standard price per unit. You know why? Because we covered this logic in basic variances, right? So you will always multiply it with standard price per kg, and then you will get your variances. Likewise, we can calculate material yield variance also. Now, like I told you, here the focus is on yield. So, here the focus is on input kgs. First, we will take actual input kgs in standard mix, and then we will take standard input kgs in standard mix. Standard input kgs will be calculated as what is your actual output, and every output should require how much input, based on which we calculate standard input for actual kgs. Okay, standard kgs to make the actual units. Always, never standard units or budgeted units. You will always take actual units. Get the difference, multiply with again standard price per kg and get the variance. And there is one more method for yield variance that we can use to calculate the variances, that is output method. Like I told you, you will compare your actual output with what is the standard kgs that can yield the output. So how much output we can have based on the standard kgs. That we will calculate, and then we multiply it with standard price per kg. But of course, if there are multiple products and I need to calculate weighted average standard price per kg. Weights are always calculated by multiplying the quantity with the price. Okay, and then we take the weighted total of it and we divide it. So simply we take weighted average standard price per kg, and here you will get your variance. Whether you calculate by output method or input method, your variance will be same. Now let's have a quick look at the sales variances. So sales variances, we have two variances, sales mix and sales quantity. Sales mix is exactly like labor only. You will have actual quantity in actual mix and actual quantity in standard mix. The only difference is here we don't focus on input, we focus on output. So we'll have actual units. Multiplied with, with sales variances. In the basic variances we have covered that we always multiply it with standard profit per unit if the environment that we are given the question is absorption costing. However, if the entity follows marginal costing, that we will multiply it with standard contribution per unit and get the variances. And remember here, if your actual sales are more than the standard, it's a favorable variance because of course you're selling more. Now sales quantity variance is again just like yield variance. Here we focus on quantity based on standards. So here I'll take what is the actual quantity as per the standard mix. Now here I cannot have standard inputs for actual kgs. So we take budgeted quantity. And again budgeted quantity in budgeted mix. We get the difference and get multiplied with again standard profit or standard contribution per unit and get the variance. Here also we can add the output method. No. So okay, here no output method, so we will follow this. I hope I'm clear with these variances. Get the logic. When it's a mix variance, you are taking the difference between the mix. When it's an yield variance, you are getting the difference between the yield. That is, what is the input capable of generating the output as per standard, as per actuals. Got it? Now let's move on to the next topic, quick revision. Now let's take up planning and operational variances. A very basic figure first I will make you understand so that these variances are just like a cakewalk for all of you. Planners are always the top level of the organization and executors are always the middle and the lower level of the organization. So planners always deal with budgets, creation and revision. Operational people always deal with, doing the actual implementation, getting the actual results. So of course, if the budget gets revised, then they will match their variances, their variances as actuals are matched with the revised budgets. Right? So planning variance is when you have a comparison between the original budget and the revised budget, because this is the work of planners, and here we have to see that what is the impact of variance due to the difference between the original budget and the revised budget. Now, the background here is, let's say I have a material price variance. Material price variance is 10,000, and if we are evaluating the manager's performance based on these variances, then manager may say that because the budget got revised, we had the variance, and the management may say that the management did not perform properly. So in order to ensure that we can fix responsibility of the top level of management as well as the managers, we have these planning and operational variances with us. Planning variances typically focus on the fault in the planning. That is, if you have adverse variance because the budget got revised, that means originally it was not prepared well. So that's a fault at the planning level, and so managers should not be penalized for the same, and their performance should not be evaluated based on these planning variances. Hence, we have operational variances in place. And these operational variances typically discuss on actually how the managers performed. So there we compare between the revised budgets and actuals to see actually how the managers performed. So let's say if I have a material price variance and a labor rate variance, which is a basic variance, if you take the planning variance for it and if you take operational variance for it, remember formula will never change. Only thing that will change is in planning variance, you will compare between the original budgeted material price figure with the revised budgeted material price figure. Likewise, for the operational variance, we'll compare between revised budgeted material price variance with the actual material price variance. Okay, so if in your planning variances, remember as a point, if your revised selling price or the revised standard price or the budgeted price is more, then it's an adverse variance, because if revision it is costing more, that means the management has done poorly, so it's an adverse variance. However, when the operational people compare the revised figures with the actuals, and actual is less than the revised, then the operational people have done well because they are able to contain this standard figure to a lowest value. So likewise, I can say for a planning variance, original standard price, if it is more than the revised standard price, it's a favorable variance, because revision by revision, the management has been able to reduce the price. So it's a good thing. Operational variance, now here you will compare between the actual price and the revised standard price, right? So if your actual price is less than the revised standard price, it's a favorable variance. And if it is more, then it's an adverse variance. Just on the line, we can have material usage and labor efficiency variance. Again, if the original standard price is more, that is here efficiency will be with respect to kgs and hours. So if your original standard kgs are more than the revised standard kgs, it is a favorable variance, because revision you have reduced it. So everything remaining same, just that like we compared between the standards and the actuals, here you'll compare between original standard and revised standard. And keep in point this formula, very important. How would you calculate the standard kgs? You will take always standard original. As per the original only, you will take the standard kgs for making 1 unit of actual output. You will never take revised kgs standards, okay? You'll always take first original standard kgs and then you will take revised standard kgs. And you will always multiply it with the standard price per unit. So the question comes in, ma'am, we should multiply it with original standard price or budgeted standard price. So keep this as a pointer firm in your head that you will always multiply it with original standard price only. Now, just like on materials, on the same lines we can calculate labor variances. Let's check the sales variances. So here again we have sales volume variance, which we further subcategorize into two categories: planning and operational. Sales planning variance is typically known as market size variance, because it looks at a larger point of view. Out of all the entities, what is the total market size that the entity has. Operational variance talks about market share variance, that it says what is the share of the entity with respect to other entities. So it is an operational variance. Don't forget these terms. Size is planning because it talks about getting the biggest size, right? The planners. Share is what is the share of the entity and comparison to its competitors. So that is the operational level variance because it is affected by internal factors. Market size is a much bigger term which is affected by external factors. Now, what is market size variance? Now, the logic remains same, that you will take the comparison between the revised budgeted quantity and the original budgeted quantity. If your revised is more than the original, it's a favorable variance. So it's a favorable variance. You know why, right? Because we're talking about sales. So with sales, we always focus on selling more quantities. So if your revised budget says that we will be targeting more quantities to be sold, it's a favorable variance. However, if your original budget says to sell more quantities and revised has reduced it, it's an adverse variance because then we're reducing the revenue of the entity. Market share variance is basically when we compare between the revised budgeted sales quantities with the actual figures. Of course, if actually the entity is selling more than the revised, it's a favorable variance. Okay, I hope I'm very clear about it. And now you have a firm hold of these as well. Let's move on to the next topic. Let's move on to the next topic, which is quantitative techniques. So it's a kind of a practical based topic, but then I have, in the last attempt also, I've seen a good question on it based on these questions, the calculations part. So make sure guys that you're good with your calculators to do the calculations. Anyways, let's go into the revision part of this quantitative techniques. Conceptual revision. So here quantitative techniques simply tell us what are the methods that will help in the budgeting process for an entity and how we can do forecasting decisions, how we can do a better understanding of the future estimates. And yes, it was tested in section B, right? So yes, it is of more of a testing area for section B as well. Number one is high-low method. High-low method simply measures that to estimate and to find out the variable cost in a semi-variable cost, how to calculate that. So we have steps to calculate the variable cost portion out of the semi-variable cost and then calculate the fixed cost for it. We typically follow the normal costing equation that says total cost is equal to A plus BX, where A is the fixed cost in total and B is the variable cost per unit. So always in the high-low method, the first step is to calculate the variable cost per unit, which what we do is in the data which is given to you, please focus on the quantities and not the dollar value. While we are on the quantities, which can be units, which can be hours, anything, take the highest quantity and get the get the parallel cost for it. And likewise take the lowest quantity of that data and get the parallel cost for it. So for calculating the variable cost per unit, we will take the difference between this total cost for the highest units less total cost for the lowest units and then divided by highest units less lowest units. When you do it, you get variable cost per unit. Now remember that you will only put this, replace this variable cost per unit in the total cost equation and make all the fact and keep the total cost equal to either as the highest level of activities or the lowest level that we used in the data. No other units in between. Okay, so either we will take the highest level or the lowest level, and in that equation you put the variable cost per unit as what you have calculated here. So when you solve the equation, then you will get the total fixed cost also. So by this you can create your total cost equation. Clear? Let's move on to correlation. Simply speaking, what is correlation? Correlation simply establishes the relationship between the two variables. Okay, between the two variables, just to know that a change in one variable will bring about a change in another variable. So if the change in one variable brings about like increase in the, if an increase in one variable brings about an increase in another variable, we call it as a positive correlation because both are going in the same direction. Let's say if one variable is going down and the other goes up opposite direction, we call it as a negative correlation. Then we have and the correlation of coefficient is determined as small r. So generally here we focus on creating a relationship between the output levels and the cost. Levels and the cost. Okay, so R would measure the relationship between the two variables. So if R is positive, like I told you, if there's an increase in one variable, it will bring about increase in another variable. Opposite for R when R is negative. The value of R, remember the range within which it is going to fall is always +1 to -1. In this range only you will always find R values to be there. If R is +1 perfect, then we say it's a perfect positive correlation. It means a change in one variable is bringing exactly the same change in the another variable, only in the same direction. When it brings the same change in another variable but in opposite direction, then we say R is perfectly -1. R is equal to 0 would mean that there is no correlation at all. Then we say there's a coefficient of determination. Coefficient of determination is simply R square, which is a step ahead of R, which simply says that this coefficient of determination determines the percentage, because in R I never talked about percentage, right? So R square talks about percentage. Then let's say if a variable changes by 100%, what is the change in another variable by 50%, 60%, 70%, whatever it is. So it would simplify the measure, the proportion of change in one variable that will change in another variable. So simply it is R square is that percentage. And remember, R square value will always be between 0 to 1. Of course, it's always positive. Let's go to the next one, which is regression analysis. Regression analysis says we will use this. We will always use the equation a plus bx, okay, to do the predictions in the future, always. And the main role is helping in decision making. So here we have few formulas, but don't worry, these will be given to you in the exam. Like R, coefficient of correlation formula will also be given to you in the exam. On the same lines, these formulas will also be given. Now, what are the formulas? Now, here in this equation of a minus bx, I need to calculate a. A is sum of y when there are two variables x and y. So, we take sum of y by n less sum of x multiplied by sum of y divided by n. And we multiply, sum a is sum of y by n less b multiplied by sum of x by n. So, comes a question, ma'am, what is b? B is n multiplied by n is the number of the line items or these numbers, quantities. So n is n multiplied by sum of xy less sum of x sum of y divided by n multiplied by sum of x square less sum of x whole square. So yes, you need to do these calculations. So keep your calculators for the same. Now here we have a concept of interpolation and extrapolation. So this I will explain with an example quickly. Let's say that the heights of the 6 students for the 10, 11, 12, 13, 14, 15 years. Now let's say the question says what will be the average height for 13.5 year student. Easy to calculate because I already have a data between 10 to 15, so I can get that accurate answer. Now the next question says that why don't you find out the height for the 20-year-old student. Now 20-year-old is beyond this numbers of 15. That means whatever estimations I will do will have some element of uncertainty. So this is known as extrapolation. Extrapolation means when you're doing predictions outside the range. When you're doing it within the range, you have generally certainty about the values. Okay, now I'll take up one of the very important topics here, time series analysis. That simply basically again is a tool to do forecasting. So how accurately can we do forecast? Time series is all about that. So now quickly, here we do the analysis of the movements and we consider factors like trends, the seasonal variations, cyclical variations and random variations. Giving a few examples, trend would be like when you see the year-on-year sales figures. Seasonal variation is like when you have a winter clothing. So in the winter season, you'll have more sales, and summer seasons, you'll have less sales. But then are they really more or not? For that, we see the trends here. Okay. Now, cyclical variation is when you are in a particular cycle, like boom, like depression, like, maturity, like growth. So that's a very long term, stay in that cycle. And random variation is any other variation which is not listed here, like suddenly you have an earthquake, tsunami, COVID, all that. So how here we're trying to understand that what is the effect of these variations when it comes to the overall costing for a project. So what is the effect of these variations? If I have to calculate my selling price, if I have to calculate the cost, then how would I consider these variations into my account? In your syllabus, we just focus on seasonal variations only and trend. We don't focus on cyclical and random, so that I will not take. Okay, when we focus on trend and seasonal variations, here we have two models that we approach for seasonal variations. To account for seasonal variation in the values, in the trends that we create, we will add or multiply seasonal variation. So there we follow two methods, additive model and multiplicative model. Additive model says that time series will be equal to adding all the variations with the trend. And multiplicative model says that you multiply these variations with the trend and then you add the two. So either you follow additive model or you follow multiplicative model. Few pointers to note, very important from exam perspective. Number one, all quarters sum total for seasonal variations when we follow the additive model should be 0. Okay, that means when you're following the additive model, the quarter seasonal variations for all the quarters should be 0. If it is not 0, then you need to make it 0. Let's say if it is coming plus 4, then you need to reduce 4 and make it 0, and 4 you will adjust equally in all 4 quarters. That is, in all 4 quarters you will do less 1, less 1, less 1. Now you will get the adjusted seasonal variation that you will apply on the trend. Now, in case of multiplicative model, the total of the seasonal variation should be equal to the number of periods that we have taken. Let's say if we are following 12-month period, then the total should be 12. If you're following quarterly period, then the total should be 4. Now again, if you have less than this or more than this, you will adjust it by adding something or reducing something, so that final total becomes 4 only. And then you will get the adjusted seasonal variation that you will multiply with trend, and after that you add it with the trend to get the answer. Okay, to get the forecast value, forecasting sales value. Now the last topic here is learning curve, that is very generally asked when you do budgeting questions. Also for labor, learning curve comes as a question, and in section A also it is very popular. So here we follow to ensure learning curve. Let me just give you a background about learning curve. Learning curve simply means that when a worker does the product for the first time, a particular manufacturing process for the first time, and then he keeps on doing the work again and again. So then from the second time onwards only he will find some reduction in his time because he's learning. Third one even more, fourth even more. But it will go on for many such units, but now then there will be a point beyond which learning cannot take place and learning stabilizes. So there we say learning stops. So here learning curve method comes into picture. Learning curve method simply says that because the worker is learning every, what do you call, so the cumulative average time gets reduced while when you're producing the next unit. Cumulative average time will be reduced because now he's becoming more efficient, he's becoming more accurate, more quicker. So he's able to do the same stuff now with less time. Okay, so now here we follow two models, a tabular approach and algebraic approach. When I say tabular approach, it simply says that we prepare the table. So we prepare a table like this. Here I will write units. Let's say it is 1, 2, 4, 8, 16. Remember in the tabular approach, we will always have doubling units. 1 double is 2, 2 double is 4 like this. And it will not be followed for any other units apart from doubling units. Then you will write here cumulative average time. you will see what is the time taken for the first unit. Let's say my learning rate is 90%. Second unit will do the same work in 8. Next unit will do the same work in 6.4 and so on. Now you will multiply it with number of units and you get your cumulative total units. So multiply this with this and this. And then you can even calculate incremental time. That is when you take the difference for every 2 levels, you will get incremental time. But here your learning curve will only be calculated cumulatively for 16 units, for 8, for 4, for 2, for 1. What if I want to calculate what is the time to be taken, cumulative average time for 25 units that the labor will take? Now I need to follow the algebraic method. Algebraic method simply says that you will use the formula y is equal to ax to the power b. Y is the cumulative average time. A is the time taken for the first unit. Okay. And x is the number of units. Let's say the number of units is 3, so it will come 3. And b is log of learning rate by log of 2. 2 is fixed. How to calculate log? I've uploaded a short video on YouTube. Please go through the same and you will get to know how to calculate log and how to calculate log for your exams. Okay, so that is going to be very helpful for all of you. Now, by this, we will calculate the cumulative average time multiplied with the number of units to get the total time, and then you can use further in the formulas. Okay, so that's for the algebraic method. Now, I think we can move on to the next topic and let's continue further. Now let's move on to the next topic, which is performance measurement. Here we'll be discussing about the different topics like ROI, like RI. Again, now these topics have been consistently asked as one of the section C questions. So make sure guys you have a hold of it, you know how to reason. I'll try to cover these points quickly in the revision session as well. Now, performance measurement we always do for the entity as a whole. So now here we don't look into the divisions or the branches or a product line. We look into the entity as a whole to do the measurement of the performance. Okay, so now here we follow performance hierarchy like we have discussed in our earlier topics. That is, an entity fixes a vision, then there is a mission. Mission basically gives you a reason why an entity is into existence. What is its broader objective? Then we have the corporate objectives created basically from the point of view of stakeholders and keeping their different, requirements in picture. For example, shareholders' requirement is to maximize the wealth. So based on which we create budgets, which are yearly budgets, right? These are known as secondary objectives because they are period related objectives like annual budgets that we prepare you. Then we make unit objectives. Unit objectives are nothing but when you further go down from the annual budgets and you have these departmental budgets, quarterly budgets, weekly budgets, like so more detailed budgets. Okay, now here understand that performance measurements discusses that we are not just going to measure the financial performance, we are also going to measure the non-financial performance. So we have financial performance indicators as well as non-financial performance indicators. Let's go first for the financial performance indicators. So to analyze the performance of an entity by, evaluating its financial data, the best tool that we use is ratios, although we can use trend analysis also that we just covered in the last topic. Okay, so ratios, with the ratio analysis, we can do different analysis like first with regard to the profitability ratios. So the ratios that we can take under this is like return on capital employed, which is calculated as operating profit by capital employed. Operating profit is simply PBIT, profit before interest and tax, and capital employed is the net assets of the entity, okay, where the entity has invested its money. If not, sometimes question will ask you, how can we improve the ratios? Improvement can obviously when your operating profit go up or capital employed goes down. Keep this in mind, look at the data and the question, and then you do analysis. Okay, one more way of calculating the return on capital employed is by multiplying the asset turnover ratio and the operating profit margin ratio. Operating profit margin ratio, margin is always on sales. So operating profit margin ratio is operating profit divided by turnover. And asset turnover ratio is turnover divided by assets. So net assets, which is capital employed. So what is asset turnover ratio depicting? It is basically about how many times that the assets they resulted in the sales. That is how many times the turnover got increased or basically got created as a result of these assets. How can we improve ROCE? Now these improvement points are very important, guys, because you will use it when you're writing your section C questions, and you can always also see it in your MCQ questions also, and then pick the correct answer. What are the ways to improve ROCE? By increasing the operating profits and by reducing the capital employed. Sometimes question says that the capital employed is reduced, and it is a good thing, but sometimes no, because many times an organization works with very old assets and they're not investing in the new assets. So although your ROCE is good, but the entity is not healthy, so you need to highlight that points also. And many times you can sometimes we can recommend that any unused assets that the entity has, it's better to sell off them so that capital employed gets reduced, entity gets funds, and also the unused assets are better to be done with reselling. Then we have operating profit margin ratio. What are the ways to improve it? Just like that, the way should be to increase the operating profit, that is by looking into how we can focus on increasing the sales or controlling the cost, or in fact by increasing the sales price, sales volume as well. Gross profit margin ratio is about sales less cost of sales. And how do we calculate cost of sales? Many times students get confused. Opening stock plus purchases less closing stock. Don't forget, if there's a direct expense, you will add that as well. Okay, and the gross profit margin is also known as the trading profit, right? Because it relates to the core trading activities of the business. In order to increase it, the entity should focus on reducing the cost and increasing the turnover. Asset turnover ratio we have already calculated. The next set is liquidity ratios. Now what are liquidity ratios? Liquidity ratios are those ratios, basically they depict the paying back capacity of the entity. That how much, how basically it is related to cash flow statement. So how good is the cash flows of the entity or the funding, the paying capacity of the entity. Typical ratios that we use here are like current ratio, which is current assets by current liabilities, and the ideal ratio is 2:1. Asset test ratio, which is the quick ratio that takes same as current assets by current liabilities, but we eliminate inventory because it is the slowest moving inventory. So we kind of look at the quick conversion of cash, okay, and which can be helpful to cover the liabilities. Inventory holding period, which is average inventory by cost of sales multiplied by 365. That simply depicts for how many days does it take for the inventory to convert it into sales. Receivable collection period, average receivables divided by credit sales multiplied by 365. Simply says that how many days that it takes for your receivables to be converted into cash. Payables payment period, it covers average payables by credit purchases multiplied by 365. So simply says again how many days does it take for your payables to be converted into cash. Now we look at the third category, which is the gearing ratio. That simply takes the risk-taking ability of the company. Okay, that simply measures that. So now first I'll discuss the financial gearing of a company. That simply talks about debt and equity. So debt upon equity or debt plus equity. Any of the two ratios can be taken to measure this gearing. Financial gearing. When we come to operating gearing, so operating gearing can be measured by, operating gearing means the day-to-day expenses which really affect the earning capacity of an entity. Which expenses affected? Fixed cost. So operating gearing is linked to the fixed cost of an entity. Okay, so simply we calculate it as contribution by operating profit. And operating profit covers PBIT, that covers an impact of fixed cost also. So simply it says how much is the contribution able to cover this profit. So if contribution is more than the profit, that means it is able to cover the fixed cost properly. Then we have interest coverage ratio, which is PBIT divided by interest expense. How many times the interest is getting covered by PBIT? Of course, the more the interest is coverage, more beneficial for the entity. Now let's look at this term, which is short termism. That is, now we are coming from the financial measures, now coming on this new topic of short termism. That basically says that sometimes the managers only target short term profits. They calculate ratios with the point of view to show that their entity is doing good, but not actually they may be doing good. So many times managers take decisions which are only considering the short term into account and not the long term, because their performance is evaluated based on this. So because of which they resort to take decisions that may be beneficial for the entity in the short run, but long run it is going to adversely affect. Now, how can we eliminate or discourage short-termism? We can eliminate or discourage short-termism by having a goal congruence, that is, the individual goals of the managers or the divisions is congruent with the business as a whole. And manager's performance should not only be evaluated only on the basis of the performance of its division or the return earned by its division on the particular, overall, but it should be also based on other non-financial performance targets also, like how much was the customer satisfaction, how much was the staff turnover, all these factors also. So a combination of this should be used to evaluate managers' performance. How can we do target setting in these qualitative areas? Because non-financial areas are very difficult to have targets for. So how can we set targets? Please look here. First, we should find out the areas that drive these qualitative factors so that we can have improvement in the performance. Second, the unacceptability of staff towards measuring these qualitative factors should also be seen. Whether they, when you're setting standards, how's the reaction of the employees, the staff, are they accepting it or not? So that is also a measuring tool. Third, how much is the motivation brought about by these financial and the non-financial targets that we are setting? What is the motivation level? If it is improved, the quality is improving for the organization. Now, what can be the different non-financial performance indicators that we can have? The non-financial performance indicators that we can have are, these are simply the performance measures that go beyond the normal financial performance, right? So they take it more forward and yeah, they take it more forward, and we just won't focus on these financial performance and the financial numbers. We go beyond it. So for example, like we assess the overall HR department by looking into the staff turnover, the gender ratio, the leaves taken by the employees, and the HR policies, how clear are they? So instead of just focusing on the financial numbers like the ratios and all, we focus more on the qualities and the non-financial performance measures. These are frequently tested topic in the exam. Just a quick tip: when you're handling the non-financial performance measures, the best tip is that, guys, when you're doing these questions for non-financial performance measures, always focus that the focus should be on improving the motivation, improving the quality levels, rather than just going with the numbers. Got it? Now let's go to the last topic for revision. But before that, I think let's take up more non-financial performance measures topic. That is how we can merge financial performance measures and non-financial performance measures, together, and then analyze the business performance for it. Balance scorecard I have also taken as a part of my YouTube short video. So do get time and just do look into it, where I have taken this again in a very short span of time. Now let's revise balance scorecard. So understand that to ensure that the overall success of the organization is there, it's very important for the managers and the management to have the all-round improvements and all-round success, which means that to take into account the financial performance measures as well as the non-financial performance measures. Here we cover in balance scorecard what is the understanding, perspectives, and some quick tips to remember. and then the summarizing it. So just giving you a background, the balanced scorecard concept was evolved by Professor Kaplan and Norton, and just to focus on the point that the business should look into balancing both the financial and the non-financial performance measures to ensure that the overall success of the organization takes place. So here we discuss these four perspectives. One is the financial perspective that obviously focuses on maximizing the shareholders' wealth. How we can measure the financial perspectives that I just discussed. Second is the customer perspective, where we focus on maximizing the customer satisfaction to ensure that the customer is satisfied. Third is the internal business perspective, or we call it as internal process perspective. Here the focus is on bringing the improvements in the organizational processes, right? The internal processes. So the focus is on that. When we take up the last one is learning and growth perspective, or we call it as learning, innovation and growth, because innovation also comes in this perspective. Here the focus is that the staff upskilling should be there and the staff training should be there and continuous improvement should be there, because these all perspectives are interlinked. How? If your staff is upskilled and trained, and let's say you have installed a software in your organization system, if your staff is upskilled and trained to use it, they will make the most use of it. If the most use of it is made with the software installed, more improvement in the internal processes may be obtained. More improvement may lead to more customer satisfaction. That means it will lead to more sales, more returning customers, and which will improve the ratios and maximize the health for the shareholders. So all these four perspectives are interlinked. Comes a quick question, ma'am, we have a difficulty in handling them. So listen to me. For each perspective, you will always write two things. It's critical success factor. That means those factors without which this perspective cannot be achieved. This target cannot be achieved. Second, KPI, key performance indicators. How can we see, how can we measure actually that whether the standards targets set have been achieved or not. So critical success factors are the targets or the goals set for an organization, and KPI is the key performance indicators that indicate whether the targets have been achieved or not. So few examples here, like for the financial perspective, my goals can be profitability and KPI can be like ROCE and net profits and others. Customer perspective, my goal can be customer satisfaction and my key performance indicator can be the complaints, the returning customers, feedback and all. Internal processes can be like, for example, a goal can be to see the response between the time when the customer placed the order and the time when the customer is getting the delivery. Of course, the time lapsed, if it is less, then it's a better processing. Relating to it, it's a learning and innovation and growth perspective where we focus on improvement in the level of customer satisfaction. No, customer service, after sales service. So better training to the staff, like, upskilling them, and amount spent by the staff training and looking into the, customer feedbacks, calling them. So that is all learning and innovation. Actually, calling them would be like internal business perspective. Clear? So these are the four areas that you have to always remember for your balanced scorecard. And these are tips, these pointers that I've told you are general points that will be there in all the questions that you answer for balanced scorecard. Let's quickly have a look at the summary of the balanced scorecard. Step 1, establish the four perspectives. Step 2, identify the critical success factors and the key performance indicators for each perspective. Next is taking appropriate corrective action to ensure that any targets, if they're not achieved, we are taking steps to make sure that they get achieved, in the next coming period. So taking the corrective action. The next topic that I'm going to revise is the building block model that is given by Fitzgerald and Moore. That also is just like balanced scorecard and discusses about a combination of financial and the non-financial performance measures. Remember that Fitzgerald and mold is typically made for the service industry. Although we can apply it to manufacturing industry, but typically it is for service industry. Like balance scorecard is typically for the trading, manufacturing, these industries. Now, Fitzgerald and Moule said that there are three building blocks that an entity will have. One is dimensions of performance, next is standards, and third is targets. So these are the three blocks, okay, based on which we assess the overall performance of the entity. Dimensions of performance are like the aspects or the areas of performance. It simply says when we are analyzing the performance, we'll have four determinants to analyze it, and the results will be for the two resultants. That is, for example, determinant is how is the quality level for the products manufactured, how the quality of the services offered. What is the flexibility? Flexibility means can you change as per the customer needs? Can you change your delivery of services as per the customer needs? Third, innovation, like we discussed in the balance scorecard. What innovation can we bring? New ideas, new innovations. Resource utilization is optimization of resources. Utilizing the resources in the best possible way so that we have no wastage or very, very low wastage. So typically talks about your productivity or efficiency levels. The higher the productivity, lower is the wastage, more is the efficiency. Now these are the four determinants we related to the results. For example, if I say competitiveness, what is the effect of this quality and flexibility on the competitiveness of the product? Overall, has the market share increased or decreased? This is then if I say financial performance, so what is the effect of this innovation on the financial performance when you brought in new ideas, whether you had wealth increased, profits increased or not, sales increased or not. If you optimize the resources well, then is it leading to the reduction in the cost? Yes or no. So these are the four determinants that we relate to the results. Once you've done these 6 areas, then we go to standards. Again, standards have 3 subtypes, 3 sub-steps. First is ownership. It says that the manager should take the ownership for the targets that they are setting, right? That means assigning accountability to the employees. And it simply means that the employees should think that it is their own targets. So employees should own the targets rather than, feeling forced upon with. Second is achievable. The target set should be achievable. So we have 4 type of standards: ideal, basic, current, and attainable. Ideal is generally not preferred. But the standard should be set in a way that they seem achievable by the employees. Only then they remain motivated. Third is equity. They should be equal targets set for everybody. I mean, the criteria should be same. There should be no partiality. So the target set should be fair and equitable. The third block is rewards. That is simply if the employees are able to achieve the targets, then they should be rewarded well. So that is, the reward should be clear. Only then the employee should know that what they will be rewarded with if they achieve the targets. Motivation, the reward should act as a motivation tool to the employees so that there is goal congruence. Controlling, on comparison with the standards, performance of the employees should be measured and analyzed, and any corrective actions to be taken should be taken by the entity. Again, like variances to ensure that their performance is better and the organization as a whole achieve its objectives. Okay, now if I interlink the blocks, determinants and results, they establish. Determinants, they establish the results. Once they established, then we match it with the standards. Okay, and then we reward the employees, okay, based on the standards evaluation. So this is how the interlink between the blocks take place. Okay, now let's take another small pointer, which is value for money, the 3 E's. Just understand the logic and you will never falter in your exam. 3 E's are economy, effectiveness, and efficiency. Economy would mean lowest cost with highest quality. Okay. Efficiency would mean that input is generating more output, so there is less of wastage. Okay, the target is that we should have more, the inputs generating the maximum output as much as we can. Effectiveness is output desired as per the standard is achieved or not. Let's take an example. If I take a laptop example, the cost of the laptop would be economy question. Efficiency is like the speed, RAM, and the other features involved to ensure that it gives me the maximum output it can. Effectiveness is whether the features that we had targeted, are they achieved there or not. So this is effectiveness. Okay, now explaining to sustainability, I think we have already covered the same thing, so let's not repeat it. It simply means that to ensure that you are using the resources in the best possible manner in a way that because of the current needs of this generation, the needs of the future generation are not sacrificed. Everybody is going to have some share of the resources. So use it in the most mindful way, in the most accurate way, so that the resources are not wastefully spent. Got it? Now, I think let's move on to divisional performance measures. When we discuss the divisional performance measures, it simply means decentralization, talking about divisions, right? From the entities, now we come down to different divisions. So till this point, generally overall in the syllabus, we always discussed about the organization as a whole. At some places, though, we discussed about divisions also. Decentralization means divisionization. That you now don't look at the entity as a whole, but reduce it down to the different divisions. And now, with respect to different divisions, now we analyze the performance. That we look at the variances of different divisions, set their sales targets of different divisions, look at the sales variances of different divisions. So rather from an entity as a whole, change the perspective to different divisions. Now here comes the main problems, because when we have decentralization, the purpose is to create autonomous, which is independent divisions to decentralize authority and responsibility. And the problem now comes in because now the problem of goal congruence becomes even more evident. The managers become more responsible towards their own divisional goals rather than the entity goals as a whole. So now here I talk about 4 type of divisions that can an entity have broadly. Revenue centers, cost centers, profit centers, and investment centers. Revenue centers are like sales offices that are typically focusing on only revenue. So their evaluation area is only revenue. Second is cost centers like accounting department, HR department, where they're just contributing to the cost of the business. So their focus area is only to reduce the cost. Profit centers are like the plant, the branch, the division, which is having both sales and cost involved. So then their focus is to maximize the profits. Investment centers are like a small company where everything is there at one roof. All the corporate offices of the entity where the focus is not just to maximize profits but to get better returns on the investments as well. So remember these 4 categorizations of the divisions or the units into different centers. Okay, now the 3 different conditions that are essential to ensure that the good performance measure is adopted is goal congruence. That is, like I told you, managers' goals and organizations' goals should match. Number 2, long-term and short-term objectives. See, generally it's a difficult point because managers, they tend to look at the short-term objectives only because they tend to fulfill these objectives in the short run to get better bonus, better increments, and better performance evaluation. Third is accountability, which is maximum needed for the areas. But accountability for which areas? Always we will have accountability only for the areas that the managers can control. For the areas that they cannot control, please don't hold them accountable. Okay, now, so if I just take it a bit forward, what is a controllable profit? And again, you will hear a term here, what is a traceable profit? Controllable profit is a profit that the manager of the division can control. For example, you have any head office expenses, a portion to the division. Now, this is not something that the manager can control, so that will not be a part of controllable profit. So that means manager's performance should only be assessed on the profits that they can control, the areas of sales and cost that they can control. Traceable profit is all that profit, all that revenue and cost that you can trace to a particular division. Okay, that you can directly trace to a particular division, even if it includes a head office expenses also. If it can be directly traced to a division, that is a traceable cost. Okay, now what is a performer that we use to arrive at a divisional operating profit? Always remember this performer, these steps. Step 1, calculate controllable profit for the division. Step 2, add with it uncontrollable profit for the division. So what you will get will be the traceable profit for the division. Okay, traceable. You will get traceable profit for the division, controllable and uncontrollable both. With this, you will add the allocated head office expenses. Remember, in the traceable profit, in the uncontrollable expenses, we don't add allocated expenses. We only add those expenses that can be directly traced to the division, not the allocated one, not the common cost. We will add common cost share later after we've got the traceable profit, and then we get the total divisional profit, that is operating profit. Now, when it comes to investment decisions, it's very, very important when we look at the investment centers, how to evaluate their performance. So we have two tools for it, return on investment and residual income. Now, generally, these are division specific, manager specific, and they're very short termed. Return on investment especially is basically for short termism. Managers, return on investment means that a manager will take up a new investment proposal only when the divisional ROI is getting met or getting exceeded by the ROI of that proposal. Let's say the divisional ROI is 20% and the new investment proposal carries an ROI 15%. Even if the overall organization's ROI is only 10%, from that perspective, it's a very good decision to go with that investment, right? But divisional manager will say, boss, I will not go for it because it is reducing my divisional ROI. My performance evaluation will go negative. So even if it is costing for the company, there is no goal congruence. But for the short term, they look to maximize their profits, their returns, so their performance is improved. So return on investment simply means that return earned on the investment, it is simply the return earned on the investment in capital employed. So ROI is calculated as profit before interest and tax divided by capital employed multiplied by 100. Okay? Return on capital employed that we did, same formula. For manager, if we are evaluating, ROI will be evaluated as control profit divided by capital employed multiplied by 100. And for the division as a whole, ROI will be then traceable profit by capital employed in the multiplied by 100. So be in the exam, be very clear what is the requirement. If they're only looking from manager's point of view, take controllable profit. If they're looking from division point of view, take traceable profit. The agenda should be that ROI should always be more than cost of capital. Okay, but there are flaws with ROI also, like I discussed. Let's look at the second tool. Now, ROI is always in percentage form. So this is a very good point also with ROI, because for comparison between the different projects we can do when there's a percentage method. Residual income that we're going to discuss now is absolute terms. So comparison becomes a challenge. But the baseline, please understand, ROI baseline is if ROI is more than the cost of capital, we should go ahead with that project. But a manager will only go ahead with the project if the ROI of the project is more than the divisional ROI. RI method is very convenient, that says if you have a positive residual income, go for that project. If you don't have positive residual income, don't go for that project. Amount is not necessary. Positive and negative only you have to see. So now, what is RI? It represents the wealth created by the division, and it represents the projected wealth for the division. It shows how much is the profit remaining after the adjustment of notional cost of capital on the capital employed. By notional cost of capital, we take what is the market driven cost of capital, and then we apply it on capital employed, and we reduce it from the operating profit of the entity. Okay, so from the manager point of view, residual income will be controllable profit less cost of capital multiplied by capital employed. And we also call it as imputed rate of investment, imputed return on investment. Okay, this cost of capital is also many times called as imputed return on investment because it is a notional cost that we are taking. From the division point of view, you will take traceable profit. That's the only difference. Okay. Last topic is transfer pricing. Transfer pricing, you know, it is the most very important topic because it is regularly asked in exam. And just remember, for transfer pricing, it is simply the price at which one division should sell goods to another division, and the perfect transfer price is the price which is acceptable by both divisions, with the ultimate aim of goal congruence, that even division A, for division A it is not benefitable, for division B it is not benefitable, but for the organization as a whole, if it is benefitable, then we should go for it. Okay, so now look here, the different methods of transfer pricing is number one, market price method. Market price method simply says the current market price is charged at a transfer price. For both divisions, they are happy because they're indifferent. The price that they would have paid to the market supplier or the customer, the same price that they are charging here. The only saving is transportation cost, which is getting saved. When we follow full cost model, that is at full cost of the selling division, the goods are sold from one division to another. For selling division, they are neutral because at least they're able to cover the full cost. They may not be very happy, but at least they're able to cover the full cost. When we talk about the buying division, they are happy, at least they are paying less than the market price. Marginal costing method is when selling division only covers the variable cost, not acceptable for selling division. It's the lowest price, right? There's no incentive to sell. But for the buying division, they are more than happy to buy. And it's the lowest price that they would be paying. Minimum cost it is. But now what is ideally recommended for transfer pricing is always full cost plus marginal method. That means full cost plus margin. No, sorry. There's one more method, full cost plus margin method, where on the full cost we add a markup. Selling division will be ready happy to sell. Buying division will be happy to buy if it is lower than the market price. Again, on the same lines, we can have variable cost plus margin method. Yes, selling division may be happy to sell because it has some margin, but if it is not covering the fixed cost, then they may not be able to happy to sell. However, I think buying division will be ready to buy because it will certainly be lower than the market price. Now we can have even HO directed cost as a tool, but this is not recommended. Both the entities will not recommend it because it will, snatch away their status of independence, which otherwise they're autonomous entities, autonomous divisions, it will snatch away that. So that is not recommended at all. Last method is what we follow always, and which is the most recommended method, is opportunity cost method, where the selling division will sell at variable cost, will be selling this as the minimum price, that they will say, boss, I will not sell below it. What is that minimum price? Variable cost plus opportunity cost. Okay, variable cost plus opportunity cost, this is their minimum price. Of course, when there is no spare capacity. Okay, we will taking that opportunity cost method is only applying when there is no spare capacity. So that will be variable cost plus opportunity cost is their minimum price. Buying division will say, boss, the maximum price that I am ready to pay is the lower of the price that he will pay to buy from the market, or the price at which he's selling goods to the final customers. And that price at which he's selling goods to the final customer, we take it as net selling price, which is equal to the selling price charged to the customer less the cost which is specifically borne by the buying division only. So their incremental cost. I repeat again, buying division will be ready to pay maximum price as the price which is lower of the price which they will pay to the market people, their market suppliers, or the net selling price, which is final selling price to the customer less the incremental cost applicable to them, whichever is lower. Okay, now here for opportunity cost, I would just add on one point, very important from exam point of view, because many students, they, suffer here. So please let me give you a tip. Opportunity cost that you will be taking will be equal to hours to be taken to produce the product to be transferred to the buying division. Okay, what is hours that will be taken to produce product to the buying division, for the buying division, multiplied with what you are going to multiply it with. This is important. You will always multiply it with the contribution lost per hour of the product whose demand is sacrificed. So if you are sacrificing the demand of division A's other products, you will take that lost contribution, and that you will multiply with the hours that you are supplying to division B. So that's all, guys. I hope this script summary gives you an added advantage for your exams and you're able to cover your revisions quickly. Thank you guys. Do comment in the chat box. How did you like this revision session? Do like and subscribe to the channel for having more such updates. Thank you. All the best for your exams and do well. All the best.